This is a year to adapt, and forecasts have been less relevant.
Let's not be too defensive. There's a real opportunity cost to being under risk.
You don't want to be short, but you do want to get a bit more defensive.
The pain trade overall still could be higher.
It's going to be potentially quite a volatile next year and a half.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. With all eyes still on the Middle East, President Trump leaving the G7 meetings in Canada a day early as fighting continues to escalate between Israel and Iran. Meanwhile, Fed officials beginning their two-day meeting in Washington, D.C. with U.S. retail sales data on deck later this morning. Where do you look? Markets right now are looking nowhere. They are quiet as they assess all of the potential risks. You have a little bit of a risk-off feel, especially given the fact that President Trump is heading back to D.C. S&P futures giving up some of the gains from yesterday, down 0.6%. What we are seeing, though, across asset is, yes, you are seeing some sort of decline, some sort of pullback in U.S. equities, although yesterday the rally was truly led by big tech. But you are seeing a bit into treasuries. 10-year treasury yields lower just a bit. You are seeing Brent crude higher as people assess the risk of some sort of escalation in the Middle East. Coming up, we are going to be speaking with Chris Verrone of Strategist as a risk-off mood returns to markets. Stephen Cook of CFR as the White House looks to set up ceasefire talks with Iran this year, potentially this week. And Krishna Guha of Evercore ISI on a wait-and-see Fed. We begin this story with our top story. Israel and Iran entering a fifth day of conflict. This as President Trump leaves the G7 earlier. Joining us now from Canada is Annmarie Hordern from the G7. Annmarie, what do we know about exactly what triggered President Trump's departure a day early from the G7 meetings?
Well, it clearly has to do with what is going on in the Middle East and obviously the continued bombardment of Iran from Israel. The president, though, is keeping it very vague in terms of what he plans to do as he just arrived about an hour or so back in Washington, D.C. We do know that he is convening the National Security Council and he plans to spend the day in the Situation Room. He told that to reporters on Air Force One as he was heading from Alberta back to Washington, D.C. And the president has maintained a continued posture here at the G7, continuously saying that Iran can never have a nuclear weapon. Obviously, there's been a ton of speculation about what the president may or may not do, especially since yesterday, Lisa, he put out a Truth Social post that actually also moved financial markets, saying that everyone should leave Tehran immediately, evacuate Tehran immediately. So while he's kept it vague, we should also note he did say that he is not leaving to go back to D.C. to work on a ceasefire. Emmanuel Macron, the president of France, had suggested this, and he said that that's wrong. I'm not going back to work on a ceasefire between Israel and Iran. Quote, wrong. Macron has no idea why I'm now on my way to Washington, but it certainly has nothing to do with the ceasefire. Much bigger than that, whether purposefully or not, Emmanuel always gets it wrong. So it doesn't sound like at this moment the president, and he also told reporters he's not in a mood to negotiate. So then the question, the speculation becomes, what is the United States doing? Right now, the U.S. has remained a defensive posture. We should look at the tea leaves. The president says Iran cannot have a nuclear weapon. We know Israel wants to get rid of sites like Natanz and Fordo. Experts have long said that that cannot be done without the help of the United States. A week ago, Lisa, the president convened his top national security military experts for a day of talks regarding Iran at Camp David. All of this is leading people to speculate potentially the U.S. could get involved at this moment in a defensive posture, not just defensively.
Yeah, and Annmarie, less than an hour ago, President Trump put out a post on Truth Social saying, I have not reached out to Iran for peace talks in any way, shape, or form, doubling down on what he put out there yesterday. This is just more highly fabricated fake news. Annmarie, aside from what's been going on with the Iran-Israel conflict and the U.S.'s potential role, what else has transpired in G7? I understand that it was really dominated by it, but this is the second time for G7 that President Trump has left early, in particular from Canada, at a time when there's a lot of question around how much the U.S. is truly looking to establish ties with traditional allies.
Well, what marks this G7 different than the one in 2018 when he left is that he left saying this was a successful meeting. I did everything I had to do. And he also left his Treasury Secretary, Scott Bessent, behind to continue having these talks with other world leaders. Clearly, trade was on top of agenda for other leaders that were coming here, trying to get a moment of his time. He did sign this trade agreement. Nothing really changed than what they announced a few weeks ago with the United Kingdom. And he presented that to the press alongside UK Prime Minister Keir Starmer. He did meet on the sidelines with the Japanese Prime Minister. And what's interesting here is that on the way back to Washington, he told reporters that Japan is difficult to negotiate with. And then on Canada, he thinks there could be some deal. He says that he has a tariff concept. Mark Carney has a different concept. But also coming into the talks when it comes to Canada, what was discussed also, Alicia, when you talk about geopolitics, the potential for some of U.S. and its allies, adversaries in the futures like Iran, when you have the Defense Department talking about how many intercontinental ballistic missiles they could potentially work on in the next decade. He said that Canada would be a part of the U.S. Iron Dome and they would pay up billions to be part of that project.
Bloomberg's Annmarie Hordern, thank you so much for all of the excellent reporting from Banff. Right now, let's get the view from Wall Street this morning. Joining us now is Chris Verrone of Strategist, a Baird company. Chris, wonderful to have you. Thank you so much
for being
here.
Thank you.
Let's just start with this idea that stocks don't know what to do with all of this. Typically, geopolitical risk has been something you fade. You buy that dip because ultimately it doesn't usually have staying power. Does this time feel different?
Well, I think we're going to have to let the market be the judge of that. You know, this conversation began with you saying that the U.S. is in defensive posture. Well, is the market in defensive posture here? I think is the bigger question for when you look at the world through the lens of price action. And I think it's inconclusive. We have not seen the real overt rush to treasuries. We just talked about kind of a very modest or benign response from U.S. 10-year yields. Gold is well below the highs from not only mid-April, but from where it was just on Friday morning. Dollar has bounced, but only modestly. So I think it's difficult to embrace this view that there's some pervasive risk-off message streaking through markets. And then when you look through some of the leadership, the cyclicals have generally held in there. The Asian markets in particular are acting very, very well here. So I'm going to kind of lean towards the market's interpretation thus far, which is this is probably something you want to fade.
Well, there's this question of what does it mean to be defensive at a time where you've got different tail risks. You've got the potential for some sort of weakening in the economy, and then you have the potential for some sort of resurgence in inflation that really challenges maybe bond valuations, but isn't that pernicious for the stock market. Which is the biggest sort of risk that you see people defending against?
I think when you go back to early April, all the attention was on what the inflation risk would be kind of on the other side of tariffs. We just never saw it. When you look at the market's messaging, it was not very pro-inflationary messaging. Our concern was always that there was a bigger risk to the growth side of the equation. And that's why I think you got to be a little careful what you wish for here on bond yields. I know it seems comforting if you saw bond yields lower here. I'm not sure that would be the best message on economic growth. If nominal growth is running somewhere around 5, you probably don't want 10-year yields much below 4. So they're hanging out here in this 440, 450 neighborhood. The market is largely acting okay. Cyclicals are largely outperforming. I think we want to maintain that very status quo as much as we can here.
So at a certain point, you have to wonder, when do bond yields become a problem for equity valuations? We've been asking that a lot. You're making the argument that at this level, not only are they not problematic, but they're actually conducive to more gains because it actually suggests this positive outlook for the U.S. economy. Is this a sweet spot? Are we kind of in Goldilocks when it comes to the yield space?
I'm skeptical of the word Goldilocks when gold is also up, right? So I got to be a little careful with that. But I do think the real trouble often emerges when you have bond yields higher with defensives outperforming. So we have bond yields roughly where they've been for much of the year, but defensives are not working here. I mean, if you look at the staples, they're back on the relative lows. This morning in our own work, we wrote about the food and beverage stocks on their lows. So you're not seeing that traditional defensive messaging. On the other side, industrials have continued to hold their own. Financials globally are largely still okay. So I'm not seeing the disruptive message in leadership yet to suggest bond yields are a problem here. What frankly, again, what I would be more worried about is bond yields moving moving lower with defensives taking grip of this market, because it would run totally counter to the narrative that, hey, cyclicals need lower yields to really work. I would be a little bit skeptical of that view here.
And basically what you're indicating is this sense of sell America and how much this is a sell America trade and sell U.S. rates trade versus just simply something that makes sense based on the backdrop in the economy. What we saw today from the Bank of America Global Fund Manager Survey for June was that investors are the most underweight U.S. dollar going back 20 years. Does this mean it's a buying opportunity if you're a contrarian, or do you think that this is something that does have legs? You
know, you got to always be a little careful with the soft and anecdotal data and the sentiment work, and certainly that survey falls into that camp. But I'll add a little fuel to the fire. I was in London a few weeks ago, and I have never seen in 20 plus years of going there such emotional bearishness on both U.S. dollar and U.S. assets, where you do begin to wonder, is there some contrarian opportunity here? I think in particular where we're seeing sentiment maybe most one-sided is actually on Japanese yen. And I say that as someone who's been a Japanese yen bull, and I just want to be a little bit careful that almost everyone I talk to is also a Japanese yen bull. So just want to be a little bit careful that the kind of one-sided thinking on USD hasn't gotten so far extreme where you want to actually think about some contrarian opportunity. Now, that said, here we are in the middle of a conflict, and dollar really hasn't done anything of great note over the last 4 or 5 days. So it does speak to this idea that perhaps, to your point, Lisa, that we're in some evolving macro order where dollar or treasuries are perhaps not as defensive or don't serve that same role that they have for so many decades.
And part of this is because people don't understand what the main risk is, right? And we've been talking about this. Is it the downside risk to growth, or is it something that has more to do with the upside to inflation, which is a reason why I think a lot of people are looking at the pain point for oil. At what point oil prices rise to a big enough level where they affect CPI to potentially push off the Fed from cutting rates at a time when it could ultimately, longer term, be deflationary or certainly stagflationary at best?
Well, it's funny. This is why we have the core, right, on CPI. I think the irony of this moment is, or really all year, the appropriate word we thought all year, and you got to be so careful saying this word, is actually transitory. Everyone's afraid to say it because of what happened in 21 and 22. But when you think about tariffs, one-time price adjustment, or the move in crude, these seem like transitory events, not strategic or long-lasting events, but there's a reluctance, for good reason, for anyone to embrace that word. I think when you look at what the move in crude here is telling us, just remember one thing. We're entering a very weak seasonal period for oil. Basically, July through October, oil historically tends to be under pressure. So I would be careful chasing crude here. This was, frankly, bottoming and improving in our work the last 4, 5, 6 weeks. We've now had the move. We're into major resistance, call it 80, 82 on Brent, maybe 78 to 80 on WTI. I'm more inclined to fade it. I'm more inclined to go back to what the leaders in the energy space are, which are power and natural gas. What are the stocks in energy yesterday making the new relative highs? It's stocks like EQT and LNG and Range Resources. It's the gas-related names, not the oil-related ones.
You said the T word. That's pretty bold.
I know.
Chris Verrone, you're going to be sticking with us.
I might regret that.
Even if you say the T word again, you're sticking with us for the hour, which we're very happy about. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We start with the latest out of the Middle East. The Israeli military says it has killed one of Iran's most senior commanders. General Ali Shadmani had only recently assumed the role of chief of staff following the death of his predecessor in a prior IDF airstrike. Iran has launched around 370 ballistic missiles at Israel, killing 24 people and injuring almost 600, while Iran says over 200 people have been killed by Israel's strikes. Meanwhile, President Trump left the G7 summit in Canada a day early. He returned to Washington early this morning, just hours after calling for the evacuation of Tehran. In a Truth Social post, the president said his departure had nothing to do with the ceasefire between Israel and Iran, and that it's, quote, much bigger than that. But before leaving the G7, President Trump and UK Prime Minister Keir Starmer agreed on a deal to implement their tariff-cutting agreement from last month. The deal will slash U.S. tariffs on key British exports and raise UK quotas on certain American agricultural products. Aerospace and steel exemptions are also in the deal, though a quota on UK steel tariffs will be decided at a later date. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Trump focusing on Iran.
Remember, Iran cannot have the nuclear weapons. Very simple. We don't have to go too deep into it. They just can't have a nuclear weapon.
Stephen Cook of CFR joins us next. This is Bloomberg Surveillance. Good morning. Welcome back. Stocks having a little bit of a risk-off tone after some commentary from President Trump as he left the G7 a day early, focusing on Iran, saying there was a lot to do and saying it wasn't because he wanted to have ceasefire talks. Right now, futures down about 0.6% on the NASDAQ and the S&P. Russell 2000 down about 0.8%, taking off some of the gains from yesterday when people were looking at big tech. Under surveillance this morning, very much Trump focusing on Iran. Here is the latest. President Donald Trump returning to Washington, leaving the G7 early, saying the reasoning was, quote, much bigger than a ceasefire between Israel and Iran. Joining us now, I'm so pleased to say, is Bloomberg's Tyler Kendall. Tyler, what do we know in terms of what the reaction is like in Washington, D.C., let alone what exactly prompted President Trump to depart Canada?
Yeah. Hey, Lisa, good morning. Well, when it comes to the reaction, we've heard from congressional lawmakers, for example, who want to have a say instead of just having the White House make unilateral decisions when it comes to this. For example, we're expecting a bipartisan group of lawmakers today to introduce what's known as a war powers resolution that would essentially give Congress some sort of vote or debate before the U.S. takes any military action in the region. Though, of course, we should say up to this point, the U.S. has assumed that more defensive posture, and U.S. officials tell us that that has not changed, though the U.S. military has moved assets into the region in recent days. Perhaps we could get some more details later on today, as we are expecting President Trump to spend the majority of today inside the Situation Room. He suggested that this is going to be a more secure way for him to make these calls and advance what he would like to see as negotiations compared to the setup that he had at the G7. He did touch down at Joint Base Andrews just about an hour ago, and he told reporters on that flight, as you've been discussing, that he is looking for something much bigger than a ceasefire. He has made absolutely clear that he wants Iran to abandon its nuclear ambitions. He said that the country would be foolish, in his words, not to make a deal. He also, Lisa, suggested that perhaps discussions could take place in person. It does appear that the White House does still feel that there could be a diplomatic off-ramp here. He did suggest that he could dispatch Vice President J.D. Vance or Special Envoy Steve Witkoff if talks do progress.
Tyler Kendall, thank you so much for that. Right now, we're going to be joined by Stephen Cook of the Council on Foreign Relations. Stephen, thank you so much for being with us. I want to start with your interpretation of what exactly prompted President Trump to leave the G7 meetings early.
Yeah, it's actually quite curious, given the fact that the Israelis seem to have this situation fairly well in hand. Israeli military leaders believe that they have about a week left to go through their target set. And the Iranian rate of fire on Israel, although continuing to be lethal, is diminishing. My sense is that the president's, the mixed signals coming out of the White House is the president trying to keep the Iranians off balance. And there is going to be a demand from the United States that if there is a diplomatic initiative, that Iran dismantle its nuclear program before the Israelis destroy it. It seems unlikely that the Iranians will agree diplomatically to voluntarily dismantle their program, however.
Stephen, and I realize this is going into the realm of hypothetical, but there is this question around whether the United States would get involved with bombing Fordo, which is their deep underground nuclear site that Israel can't really reach with their equipment. They don't have the bunker busters that the United States does. What would be the consequences of doing that in terms of the international reception, what that does to the potential conflict or reduce the nuclear threat?
Yeah, I think certainly if the United States were to bomb Fordo, it would reduce the nuclear threat. While there might be certain international outcry, I think that privately people would be relieved that the Iranians would be disarmed. But I wouldn't assume that the Israelis don't have any options themselves with regards to Fordo. They have been looking at this problem for quite some time, and they may, in fact, have figured out a way to pick the lock. They suggest that they will complete their tasks within a week, and that includes Fordo. So it may not be necessary to have a B-2 with 30,000-pound bunker buster bombs aboard, but we'll just have to see.
Stephen, it's Chris. When you think about why this president, or one of the reasons this president was elected, it was on less foreign engagement. Do you think taking a more active role in the Iran conflict here kind of puts that at risk?
Oh, well, certainly the president's America First outlook means reducing America's footprint in certain areas around the world. The president ran for office 3 times, in part because he was opposed to getting the United States involved in foreign adventures, particularly in the Middle East. However, he's been fairly consistent with regard to Iran's nuclear program since becoming the president, and has said that there needs to be an end to this program. And he did say in response to critics the other day that he gets to determine what America First is, not commentators like Tucker Carlson and others.
Stephen, I think one of the risks whenever there's a geopolitical event is you get very caught up in the first order thinking. What is the second and third order thinking here that maybe the consensus is not focused on?
Well, I think that the folks are focused on the actual conflict, and that makes a lot of sense, whether the United States is going to be involved, what that does to the markets. I think there's a longer-term goal here on the part of the Israelis that has been kind of nodded at and winked at, which is to weaken the regime in a way that makes it possible for Iranians to rise up and engage in regime change themselves. That would be a paradigm shift in the international system, and particularly in the Middle East. A changed Iran, perhaps a more benign government, maybe not, though it would necessarily mean a very, very changed Middle East.
Well, we've dealt with this quite a bit, and let's build on this, Stephen, this idea of regime change in the Middle East. We've seen this movie before in various iterations, time and again, and it often doesn't go as well or as smoothly as people thought. How much do you see an actual viable leadership, aside from just some sort of rebellion among the Iranian people, a viable leadership in the wings ready to take over should the current leadership be deposed?
Yeah, I mean, this is what's so risky about this. Now, the Israelis aren't saying that they're engaged in regime change. They're saying they're going after the nuclear program. But it seems clear, based on what they're targeting and the kinds of things that they're saying, that they wouldn't mind if the Iranians rose up and changed their government. The Iranian opposition is hopelessly and woefully divided among itself. We have seen the Shah's son, Reza Pahlavi, raise his profile in the course of the last couple of weeks or so. But it will be a struggle to build a new, decent government in Iran. I don't think anybody believes that this isn't anything but an incredibly risky strategy.
Stephen Cook of CFR, thank you so much for spending the time with us this morning as we try to understand what the ramifications could be and whether the United States would be looking to get involved. Chris, you did raise that point, this question of if this president ran on America First, how does this sort of change some of the calculus? If you take that a step further in terms of second order, what does this do to the one big beautiful bill that we hear going on in Washington, D.C., some of the trade agreements in terms of, as an investor, what you focus on and how much that gets delayed as this takes center stage?
Well, I think just to kind of go back for a moment, when you think about what were the 3 tenets of the campaign, it was immigration, it was tariffs, and it was less foreign engagement. And he's 2 for 3 so far, and I think this is the one that's out there that potentially goes against what he campaigned on. So I would still be surprised, kind of when I look at the market's message, I would still be surprised if we entered this in any big way. I think the market's still treating this fairly benign at the moment. I think the harder question, Lisa, as you ask, is what does this do for all the other priorities that are currently on the table, namely trade and taxes? The timeline is not particularly generous here. We do not have a lot of calendar left in the congressional cycle here before we get to a point where this tax bill has to get done. So, again, I think the market's message will be a kind of a key guide in that regard.
Just quickly, Chris, what would markets do if the U.S. did get involved?
Well, I think we'd certainly see gold to new highs. I do think ultimately things like treasuries would come back as a traditional safe haven. I am skeptical of the view that these things are no longer the safe assets in the world. I think that is way overhyped and way overblown. And
right now we are seeing a bit of a bid into treasuries amid some of the risk-off yield that we're seeing in equities. Yields lower just a touch as the Federal Reserve begins their 2-day meeting. You do have the sell-off in futures, just a touch, taking off some of the heat from yesterday. Coming up in the next couple of minutes, we've got Krishna Guha of Evercore ISI on a wait-and-see Fed. They don't have the luxury of any kind of visibility like the rest of us. This is Bloomberg Surveillance. A little bit of edginess this morning as people assess exactly why President Trump departed G7 meetings early to go back to Washington, D.C. to get into the Situation Room to really understand and navigate what's going on in the Middle East. You're seeing stock futures off about 0.6% on the S&P and NASDAQ, down 0.8% on the Russell 2000. 3 hours away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with solar stocks absolutely plunging after Senate Republicans unveiled a bill that would end tax credits for wind and solar by 2028. That's years earlier than for other energy sources like nuclear. So as a result, you are seeing Sun run down 27%, while Solar Edge Technologies and Enphase Energy are also down. That's because analysts have already warned that ending these tax credits would decimate the solar industry, though I will add that the bill could still change. Next up, we have shares of T-Mobile. They are down 4.7% now after SoftBank unloaded 21.5 million shares of the wireless provider at a slight discount in one of the biggest U.S. stock sales this year. The nearly $5 billion haul will help fund CEO Masayoshi Son's massive push into AI, including a potential investment of $30 billion into OpenAI, but coming at the expense of this stock today. And take a look at shares of Verve Therapeutics. They are absolutely soaring, up 78% on an FT report that Eli Lilly is in advanced talks to buy the gene editing startup for up to $1.3 billion. That deal would double Verve's market value and give Lilly access to a promising cholesterol treatment at a time when it's trying to expand its pipeline beyond those blockbuster weight loss drugs. Lisa?
Thank you so much, Yahira. I guess it's Merger Tuesday as well as Merger Monday. On our radar this morning, President Trump leaving the G7 early as Israel and Iran enter a fifth day of attacks, conflicting reports about why he left, leaving markets on edge. The president saying it's bigger than a ceasefire. Chris Verrone still with us of Strategist. And Chris, I have to wonder, as the markets game out how this looks, is the biggest risk some sort of blocking of the Strait of Hormuz, the idea of free oil flow, or is it the United States getting involved with a lot of unpredictable ramifications?
I think it's more the latter as the bigger risk. I mean, I went to bed last night expecting to wake up this morning to see futures down meaningfully, to see treasuries very bid, to see oil through the highs. And none of that here has played out. And, you know, what we wrote to clients late last night and again this morning is very simply, you know, pay attention to Friday's intraday highs when the news kind of first broke. VIX, I think, was 22. High yield CDX was 350. Crude was, 77, 78. I think those are important kind of near-term thresholds to get an understanding of whether the market sees a real risk starting to materialize from here.
And I think a lot of people are watching to see what transpires in the Situation Room and how much it distracts from some of the other agenda issues. And this is something we were talking about earlier. President Trump and UK Prime Minister Keir Starmer reached an agreement to implement some elements of the trade deal announced last month. The U.S. will slash tariffs on key British exports, and the UK will raise quotas on certain American agricultural products. An immediate cut on steel tariffs, which was a key British demand, was not included in the deal. Chris, how much are we learning about what the red lines are, about whether the United States will drop tariff rates below that 10% sort of floor, about how quickly we're getting some sort of resolution ahead of a deadline that's fast approaching?
Yeah, it's a deadline that's fast approaching, which is unique for markets, the idea of a deadline, because you think of markets as discounting type where all the information is known or processed before the deadline approaches. So you kind of wonder how this deadline is going to play out. I think when you look at the UK deal, I think the issue that the UK here has is the currency is just too strong. And for an economy that's probably in a weaker spot than we are, where bond yields have gone up more in the UK, plus a strong currency, that's not the best recipe for some economic revival in the UK here.
So at a certain point, do you see this as being a sticking point increasingly for countries that are getting challenged by having a stronger currency at a time where the U.S. is arguing for more trade deals, but also getting benefited by the fact that the dollar has weakened so substantially this year?
Well, I think it highlights the risk we talked about at the beginning of the show, that sentiment on dollar is just so one-sided here, whether you look at the BAML Fund Flow Survey or whether you look at our own work. It's about as extreme as I've seen in 20 plus years of doing this. So I do think dollar shorts at least should be open to what new information could hurt them here. I think in particular, frankly, I think the most important kind of part of the trade agenda is what happens in Japan here. Because you have the BOJ in an interesting spot here. And they just finished a 2-day meeting. Rates were pretty benign coming out of that. Yen was pretty benign coming out of that. But we have seen massive strengthening in the yen over the last year, from this time last summer, 160 to call it 140 and change right now. I think that is really the big elephant in the room.
Which is the reason why maybe you saw a bit of a dovish tone from the Bank of Japan overnight. The three prongs of the stool, as we're talking about trade, we're talking about the bill in Washington, D.C., and of course, we're talking just in general about how we get sort of GDP up in some sort of substantial way. Senate Republicans plan to cut trillions of dollars in taxes in their version of the president's big, beautiful bill to offset the cost. Senators are looking to repeal some clean energy tax credits and scale back Medicaid benefits even further than the version passed in the House. How much, Chris, can we actually take a look at this and game anything out in terms of deficit, in terms of spending cuts for states, versus just sort of discount this as a negotiating tool for now, ignore, focus on other things until this gets into a more baked form?
You know, I still think for the market, this is probably the biggest game in town here. Just frankly, the timeline is short. Now, remember, this will have to go back to the House when all is said and done here. I do think if we're trying to arrest the potential of some economic slowdown, the bill has to be kind of most important on the list of things going on right now. And, you know, one of the reasons we think we have seen this kind of renewed life in cyclicality in some of the cyclical groups is anticipation that this gets done. So, you know, very important for our view and for our call that, hey, the economy is okay here, that this bill gets done sooner than later.
And something that the Fed is going to have to take into consideration as they begin their 2-day meeting, which is kicking off today. The FOMC widely expected to hold rates steady, but it does plan on updating its economic forecast. Krishna Guha of Evercore ISI joins us now. Krishna, are we expecting to hear absolutely anything other than we are in a dark room with a blindfold, bumping into chairs just like the rest of you?
So I'm afraid you probably are going to get a lot more wait and see, a lot more to learn. You know, it's that sort of guidance from Fed Chair Powell, consistent with the idea that unless something radical changes, not only is nothing happening at this month's meeting, but nothing's going to happen in July either. And then really in September, we have that decision point for the Fed. Has it seen enough to want to cut rates at that point or not? I think what the market will be focused on at this meeting is really the extent of the updates in the Fed's forecast, and in particular, whether policymakers are already shifting towards just a 1-cut baseline rather than 2 cuts for this year.
Krishna, how much does it really matter? Because right now the Fed seems highly uncertain, very much on the fence. Their sort of strategic analysis is shape-shifting depending on the day. And we're seeing data that hints at something of a labor market softening that's caused a lot of people to be a little bit concerned. I'm talking about continuing claims. We're going to get retail sales in just under 2 hours' time. How much is that almost more important than the rhetoric that we hear out of the Fed right now?
So I think you're certainly right. That first of all, you know, the real action here is on the Trump economic agenda, above all trade, but also immigration, fiscal, you mentioned, you know, regulatory, other policies. And the Fed, to a large extent, is responding to those shocks and learning from the economic data how they are impacting economic activity. So, yes, you know, the Fed is going to take its cue from, first, the path of policies like trade policy. Secondly, how this is filtering through the macro data, the market data. But it does matter what reaction function the Fed is sketching out that it will apply in these different economic circumstances. You know, there's a relatively easy case where the labor market doesn't weaken at all. Well, why are you cutting in a period when inflation is going to move up under these tariffs? Conversely, if the wheels come off the bus in the labor market, for sure we know they're going to be cutting, even though there's going to be elevated inflation, provided that the expectations remain well behaved as they are right now. The question is, in this middle zone, in this gray zone, how are they thinking about, you know, what would constitute a material enough weakening of the labor market to want to cut, to lean against that getting any worse? And also, what do they think they're learning from the most recent data, which certainly is imperfect in the way you describe. But I'd say for May, overall, top tier, employment report and inflation, both a little more benign than might have been expected.
Hey, Krishna, it's Chris. Can you talk just for a moment about kind of this divergence between the market rate and the policy rate? We've always joked in our work that who needs Fed speakers when you have the two-year yield? Is there a level on the two-year yield down where you'd say, okay, the Fed is now behind the curve and kind of needs to get back in the easing cycle maybe faster than you thought?
Yeah, so that's a very good and important distinction to draw, right? The Fed obviously sets the overnight funds rate, but it's the 2-year, 5, 10, and so on rates that are much more important for the economy as a whole. And of course, those will also embed information as to how market participants are thinking about the outlook. What I would say is that the Fed doesn't try to micromanage, the 2-year yield. It couldn't, even if it wanted to. And so I don't think that it's so wildly out of whack right now with what Fed officials might be thinking on a probability-weighted basis, because remember, the market isn't just pricing the baseline case, but they're pricing a range of risks, including the risk that we do, after all, end up falling into a recession. The Fed has to cut a lot. So right now, I think the Fed will be comfortable to let the market operate as a little bit of an automatic stabilizer. Rates going down in the market when the news is weaker, rates moving up when the news is stronger or there's signs of some more inflation pressure. They're not yet at the point where they would feel the need to make a call on rates themselves in terms of the Fed funds setting.
Krishna, do you think kind of in the spirit of the Fed might not make the same mistake, they might make new mistakes, that 2021, 2022 is coloring their thinking too much on this idea of kind of the inflation risk? Maybe in a lot of respects, the appropriate word to use today, and we talked about this earlier, is actually transitory, given that tariffs are a one-time price hike or oil, yet they're so reluctant to do that because of the recent experience.
So look, at some level, I think you're right? Everyone fights the last war, and the Fed can be guilty of that too. There's no question that the fact that the Fed, went out with a transitory story and lived to regret it last time is, I think, coloring their thinking some this time too. But there are two important sort of objective considerations there that do weigh a bit in this direction. The first is that these tariffs are not simply on end products, they're also on intermediate goods, inputs into U.S. production. And it's those tariffs on intermediate goods that the economic research tells us can have more persistent effects on inflation, not just a one and done sort of, if you like, tax increase effect. The other thing is that the Fed does have reason to wonder whether inflation expectations, wage bargaining, price setting behaviors are quite as well locked down now after several years of elevated inflation as they were previously. And these starting conditions, economists will use the term initial conditions, do matter in terms of your risk management judgment.
Krishna, just real quickly here, if I were cynical, I would think the Fed would just err on the side of being more hawkish in order to keep some of the inflation expectations restrained. Why isn't that the case, that we can basically expect them to say something that is going to be hawkish whether they think it or not?
So I think they are mildly hawkish. I mean, after all, they're telling us that they judge that the current setting of policy is moderately restrictive, modestly restrictive. Individual officials use different terms, but restrictive. Why is it restrictive? Well, it's restrictive precisely because, as you say, they want to try to lock down inflation expectations into the initial sticker shock from the tariff price increases when that comes. And as I said, it hasn't really shown up in May. We do expect it to show up more over the next few months. Near term, that's certainly hawkish, but I think it's also important to understand that the Fed recognizes that a precondition for being able to cut rates in response to labor market weakness at a time when spot inflation will be high because of the tariffs is that you have to make sure that you've locked down the inflation expectations first. So yes, it's moving in order of priorities, lock down the expectations first, then look at business cycle management. But if they get the first right, they will have the flexibility to do the second if it's needed.
Krishna Guha of Evercore ISI, thank you so much. Really insightful.
Thank you.
As always. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. The Bank of Japan held interest rates steady at 0.5% and unveiled a plan to slow bond buying. The decision follows recent sharp moves in JGBs that rippled across global debt markets. BOJ Governor Kazuo Ueda saying that tapering bond purchases too quickly could have a negative impact on the economy due to abnormal volatility in yields. Meanwhile, Russia has carried out one of its deadliest attacks on Ukraine's capital this year. At least 14 people were killed in Kyiv and another 44 injured as Russia unleashed hundreds of drones and dozens of missiles across the country. It's the deadliest attack on Ukraine since at least April. And Copenhagen dethroned Vienna as the world's most livable city in the Economist's Global Livability Index for 2025. And here's another reason you'll want to check out Denmark. It dominated Scandinavia's culinary scene last year with 38 of the region's 96 Michelin-starred restaurants. That kind of felt like an ad. That's your Bloomberg Brief. Lisa?
Well, Yahara, if that was an ad, I will say that was the topic of conversation last night at the dinner table in Casa Abramowicz. Up next, a shock to oil.
It really all does depend on oil. If oil prices change their trend from being in a downtrend over the course of the last 3 years to start to trend higher, this is when this turns from being a contained geopolitical risk to being something that will have a more lasting impact on markets.
Joining us next, Nitin Kumar of Mizuho. This is Bloomberg. Futures selling off just a touch ahead of the open here, less than 2 hours away. We are seeing stocks down about 0.7% on the S&P and NASDAQ. Under surveillance this morning, something we're very focused on, a shock to oil.
It really all does depend on oil. If oil prices change their trend from being in a downtrend over the course of the last 3 years to start to trend higher, this is when this turns from being a contained geopolitical risk to being something that will have a more lasting impact on markets. Because we're dealing with exogenous shocks, this is a big issue for inflation readings. It hamstrings the Fed and it causes pressure on the consumer.
Here's the latest. Crude prices gaining yet again as fears escalate that the Israel-Iran conflict may disrupt oil flows. Nitin Kumar of Mizuho writing, while it is too early to change our cautious outlook for global oil prices from oversupplied markets, the move has increased the short-term risk premium in oil prices. Nitin joins us now. Thank you so much for being with us. We are seeing oil prices up yet again, touching some of the highs that they reached 2 days ago or 2 sessions ago when the conflict was much fresher in people's minds. What are we currently pricing in when you look at crude prices at $73?
So I think, thank you for having me, by the way. So I think right now we're really pricing in the risk of an elevated risk. If you look at what happened on Friday, the market obviously was shocked by the Israeli action. But then on Monday, we retreated a little bit as things seemed like they were not escalating as quickly or perhaps as dramatically as people feared. Historically, what we have seen is that in events like this, oil can go up from somewhere between 7 to 8% on average. That would mean a range of around $5 to $10 above where it was trading before the conflict escalated. So if this continues for a little bit longer, we can see maybe $80 oil, which would put us in about the $10 range. And then really it depends on the path of the conflict from here on out. There's a lot of scenarios. I don't want to get into the doomsday scenarios, but then you could see oil higher. But what we are really focused on is the path that this conflict takes, and we don't want to call the end of the down cycle in oil from the supply and demand perspective, but we're waiting and watching and seeing how it plays out.
Nina, talk for a moment just about the shape of the oil curve here. I think at one point on Friday, backwardation to the degree of maybe $7, $8 between front and 12 months out. How do you interpret that as a message for what the longer-term trend in spot is?
Well, the longer-term trend in spot has been downward. There's been backwardation for most of this year. I think this is a spike in the short term. I think investors and markets are not prepared for a true escalation. With the scenario you talk about, closing the Straits of Hormuz or land war or U.S. involvement, things like that. I think people are putting a very low probability on those kind of events yet. So then you see the fundamentals take over. You still have OPEC Plus adding barrels. At least they've said they would do that. The U.S. is going to slow down. Our view is that it's not going to decline in production. It's just going to flatten out. You still have certain parts of the world that are producing more oil. So I think the market is used to, unfortunately, over the last 4 or 5 years, this little elevated risk on the front end of the curve, but they are really watching. I think our view is that Brent is somewhere in the $70 to $90 range, with 90 being times when things are a little bit hot out there, and 70 being when things are a little bit more calm.
On the sentiment front, last I checked, positioning is still very, very light. Do you think that contributes to, what could be a surprise to the consensus in higher prices?
Absolutely. So going into this conflict, I think most investors were positioned for oil to have a downward move in the second half. You expected to see OPEC barrels hitting the market. Even though we're not calling for a recession at Mizuho, demand is robust, but it's not spectacular. Million barrels, maybe a little bit more than that. So the view was that the market would be oversupplied. You could see almost 1 million barrels of oversupply by the fourth quarter, depending on the OPEC path. So I think investors are largely positioned for a move down. They've stuck to quality. They've stuck to names that know how to ride out a recession or a downturn in oil. Natural gas has been the favorite play, as you know. So I think this could have the impact of shaking people loose, but it's too early. We're only in, I think, day 3 or trading day 3 of this conflict.
We've had a lot of volatility in the oil markets for a long time, but particularly over the past 5 years. What have we learned in terms of when oil prices get high enough, they become somewhat self-limiting in terms of just the supply-demand dynamic?
Absolutely. So there's no cure for higher oil prices than higher oil prices, right? So you could see demand destruction. You could start seeing...
At what level?
It really depends on the time it takes to get there. If you get to 100 very quickly, you're not going to see a lot of demand destruction. I mean, people have already made plans to probably drive around in the summer and things like that. But over time, absolutely, if it stays at 100 for a while. The other impact is supply, right? The U.S. is slowing down, as I said earlier, the growth profile. But we have a lot of reserves. They could choose to at $100 oil, a lot of shale reserves could be very economic. We could incentivize exploration offshore. So depends on the time frame, how long it stays. If it's $100 for 3 months, I don't think it destroys demand or incentivizes supply. If it's there for a year, absolutely.
Nitin Kumar, thank you so much for being with us today. Nitin Kumar of Mizuho. Chris, do you change your driving plans depending on what you see in terms of the gas board?
I do not.
I will say, though, it does affect, though, the psychology when you see that. I mean, it is a billboard for inflation. It might as well just be saying, hey, this is what consumer prices are doing. Yeah. It does affect things.
Yeah, it certainly does. And I think maybe the one question here, kind of in context of our broader discussion about the administration, is when does now, if it's higher rates and it also becomes higher gas prices, when does that start to weigh on some of the agenda?
And that's the reason why this complicates what the Federal Reserve is dealing with in the 2-day meeting. Chris Verrone of Strategist, a Baird company, thank you so much for spending the full hour with us. Coming up next, we've got Alicia Levine of BNY Wealth, former senior Trump trade advisor Kellyanne Shah, the son of the last Shah of Iran, Reza Pahlavi, and Saab CEO Micael Johansson, as we try to game out how CEOs are thinking about such an incredibly uncertain moment right now in markets, taking it in stride, although a bit off balance, just given the fact that there does seem to be some sort of escalation in the Middle East. Futures down across the board. Bond yields also down, prices up, with a bit of a bid into that haven trade, 4.42% on the 10-year. This is Bloomberg.
Our call has been the Fed shouldn't cut.
I don't think that you can expect much from the Fed this week.
We're not in a weak economic backdrop. The Fed's going to have time to evaluate.
They will continue to sit on their hands. They'll continue to say we're being patient.
It's at least going to look like the FOMC is prioritizing inflation over the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Questions swirling about the U.S.'s involvement in the escalating Israel-Iran conflict as President Trump heads back to D.C. a day early from G7. The Fed beginning its 2-day meeting in Washington, D.C., trying to assess all of these risks. And U.S. data on deck with May retail sales as we try to understand what the consumer is doing with all of this uncertainty. John is off this week. I'm so pleased to say that Danny Berger is with me for the next 2 hours. And Danny, it is just striking to see clearly the market's getting whipsawed, at least on the margins, by this sort of tit for tat that we see on Truth Social, on Twitter, about what may or may not be happening.
Exactly. It's a market that without those various posts or various speeches coming in, it wants to rally. You really get that feeling. Yesterday, we were just 2% away from all-time highs. But I'm going to be honest, it feels kind of crazy when we still have trade negotiations going on, the big, beautiful bill, and of course now Iran and Israel. Just the comments from President Trump, him leaving early, shows how dangerous it is to get complacent, that they can be pushed around really easily.
You know, if that hadn't happened, we'd be focused on retail sales. A lot of people saying that this actually is a key read on the U.S. consumer and just how resilient they are to some of this uncertainty. How do we sort of weigh this at a time where the Fed has to now look at the potential for oil prices to increase and potentially some disruption in the Middle East as yet an additional shock that they've got to take into consideration?
It is a Fed's own model that says for every $10 increase in oil, you see both a similar uptick in both inflation and a downtick in growth, something like 0.4%. It already adds, to your point, to calls for stagflation. So what is the Fed going to concentrate on? What are we going to get? To your point that you've been speaking about all this week, maybe it is nothing. Maybe their hands are tied with the blindfolds on.
Right. And though how they really see scenario analysis is going to be important. Coming up, we're going to be talking about that as we look at futures that are lower by about 6 or 0.7% throughout the morning. We do see that retracing just a touch. We are seeing a bid into bonds, yields lower by about 3 basis points on the 10-year, 4.42%. A bit of euro strength. We've been seeing it kind of hover around this range, 115.70 versus the dollar. Crude prices up once again, and this is important. As we do wonder what exactly is going on. Is this a push for some sort of conciliatory measures, or is this some sort of escalation in the conflict? Coming up this hour, we've got Alicia Levine of BNY Wealth as stocks look for a second day of gains, maybe, although taking off some of that right now. Former NEC Deputy Director Kellyanne Shah on the latest trade negotiations. And don't miss this, the son of the Shah of Iran, Reza Pahlavi, as President Trump calls to evacuate Tehran. We begin this hour with our top story, President Trump leaving the G7 summit early as the Middle East crisis escalates. Anne-Marie joining us from the G7 in Canada. Anne-Marie, what have we learned in the past couple of hours in terms of what President Trump will be doing and what the response has been in Washington, D.C. to this early departure?
Well, the president is now in Washington, D.C., and he said he was going to spend the morning in the Situation Room with his top national security team, foreign policy advisors. The president made it clear to reporters traveling back from Canada, from the G7 to Washington, D.C. overnight, that he wants a real end to what is going on, more than a ceasefire, something that is a real end. An end, a real end, not a ceasefire, an end. That was the quote he gave reporters. So what exactly does that mean? It's been kept very vague, but the president has made it clear Iran cannot have a nuclear weapon. So obviously there's growing speculation that the United States, which of course has a defensive posture in the region and has been aiding Israel when it comes to the defense of the Iranian missiles being sent over, the question becomes, will they join offensively? Experts have long talked about the fact that if he wanted to eradicate Iran's nuclear strategy, you'd have to go after Natanz and Fordow, two of these sites, and many just believe Israel does not have the capabilities to do so, and they could not do so without the U.S. help. That has been a growing question over the course of the last few days as these two countries have continued to strike each other. But so far, the U.S. has not entered in an offensive way. The president, though, over the weekend, before he was at the G7, said it was, quote, possible. So this is what everyone is going to be watching today, with the region and Washington, D.C. on high alert.
Yeah, Anne-Marie, thank you so much. And certainly everyone in markets is watching this closely as well. On Wall Street, Alicia Levine of BNY Wealth writing, absent a sustained rise in energy prices, we do not see geopolitical risk affecting markets more than the immediate trade. Alicia joins us now. It's sort of the classic geopolitics by the rumor, right? It's sort of the idea of any kind of sell-off is a buying opportunity, considering how long this typically lasts. Does it feel like there could be something different this time?
So, yes, there could always be something different, and these things can always spin, and it's a dangerous part of the world, and there's some nasty weapons there. And I would suggest, I think we were talking about all this was hitting at 9 o'clock last night, hard to go to sleep for an early morning show, and yet we woke up and nothing happened. Maybe it's clear that there's some strategy here as yet unknown. And look, in the end, we've done a study of all of geopolitical hot conflicts, crises, going back really to the 1950s. And what you see is that absent a sustained rise in energy prices, the immediate trade of risk off, markets down, really gets priced out of the market after 3 to 6 months. The only way it's really sustained as an investing issue is if you get real yields higher and energy prices sustainably higher. I would suggest that energy, in the low 70s is not there, and actually shockingly low. If I had given you a set of facts a few months ago, this is going to happen, where's energy? I don't think any of us would have settled on 72 for WTI.
Right. There was this very muted response in markets. And what didn't happen might have been more instructive than what did happen. You didn't get a sell-off in risk in a massive way. You didn't get a bid into the dollar in the way that you'd expect, or into long-term bonds. How much is that instructive of the path ahead in terms of what does and does not work as a haven asset?
Well, I think that was the most surprising thing of all. It wasn't really that the S&P was indicated down 2% on the open on Friday. It was that there was no bid for bonds and no bid for the dollar, suggesting the dollar is actually probably going lower, because this is the setup where you would see a rush to safety, and it wasn't there. So that's really interesting as well. But also, it does go along with the thought that markets are actually doing what they did before, right? You don't see any real interesting trade here coming out of this. It's been 2 or 3 days. Let's not get complacent. We could have interesting dynamics happening, but essentially it's the same trade. And to your point, we're sitting here at the S&P over 6,000. The headlines are terrible, okay? The pictures are worse, and yet the market wants to go up. And so I think this is where we are. Now, it can change, but again, stepping back, geopolitical risk is not an investable thesis unless you're a trader. And even the traders didn't really get what they needed out of this.
With stocks above 6,000, how much of that is conviction that we're okay, we're resilient, versus lack of any conviction? So you kind of just go with the same playbook that you've been talking about.
So I think there's a lot of lack of conviction. What we saw was that, retail coming in and buying the dip, because actually that has worked. For the last 5 times where the market has fallen 20% or more, going back to 2016, buying the dip was always the right move. I'd say there's a conviction that earnings have stopped moving lower. And if you look at the forward 12 months on the S&P earnings, they've inflected higher slightly, but they've stopped declining. And 2026 is stabilizing as well for earnings. So, in the end, markets multiple times earnings. And if your earnings have stabilized and moved higher, then the market's fine. Having said that, it's not an inexpensive market. We're looking at 22 times forward earnings. So we're back to where we were in January with a different set of risk and a different set of facts, which look worse. So we probably have some volatility over the summer, because summer's never a great time for risk assets. It just isn't. But ultimately, it's not mispriced here. Is what I'm trying. It's not mispriced. You can always, you could always get a sell up, but it's not mispriced.
But even with that return to January, it also feels what's faded to the wayside was this whole narrative of sell America, broaden out, go to Europe. There was the most recent fund manager survey from Bank of America that they reckon over the next 5 years, global stocks will beat U.S. stocks. Do you still lean into that trade, that it's time to move away from American equity?
I love that you asked this question, because our answer is an emphatic no. And in fact, we actually put out a piece about, we think the sell America and the American exceptionalism is dead trade is essentially very short-sighted. And it's a tactical trade for the year, because U.S. growth is slowing a little and Europe is growing a little bit more. With the dollar weaker, other markets look more attractive, particularly as you get that rotation out of the. So that makes sense. But to fade the U.S. market, and we say this in many different ways, but let's just say it very clearly here. To fade U.S. markets is to fade the AI revolution. And that is the big picture. So the productivity of U.S. companies will move higher. The margins on U.S. companies will move higher. Don't see AI, aside from China, coming out from the rest of the world. And so you're in an ecosystem here that is going to be nurtured and funded by capital markets, by venture, by privates, and by public capital. And this is where you have to be. It is a long-term view. Yeah, I mean, look, in the end, we're all judged by how we do by the end of the year. So obviously, there's going to be trading around that. But ultimately, for a strategic view, you must be overweight the U.S. versus rest of world. I love that everybody's so negative because I like the contrarian trade. I just don't see it as reality. Think about Europe, 27 countries, collective action problem. How in the world are you going to make corporates more productive in that situation?
This is a very impassioned argument for U.S. equities. It is not an impassioned argument for either the dollar or for rates. And this raises this question of whether you're talking specifically about specific companies that have technological advancement that is appealing to people around the world, but not the United States per se, as we can see with potentially a weaker dollar and potentially more of a yield premium on treasuries.
So I think the long end still presents a problem for investors. But again, that's also become something of a one-way trade. Obviously, the discussions in Washington have been disheartening to the bond market, but yet yields are not running away here on the 10-year. We're still in that range of 430 to 460. So despite the concern of long duration in a world where we're running $2 trillion deficits, it's not running away yet. Now, obviously, there's some term premium in what's going on with the deficit. It's going to have to be addressed. And ultimately, it is a conflict between growth in the economy and bringing down the deficit. Very hard for any politician to really make that decision. Ultimately, we think Washington will have to start addressing this in some form because this is impossible. So I do think the dollar goes a little bit weaker here, just because if you're moving out of U.S. assets, moving out of the U.S. Treasury market, dollar will go weaker as well. I don't think that's fully sustainable. I just don't. I think it's a one-way trade right now, and everybody's so negative. And we've been in markets long enough that we know when there's a one-way trade, it tends to go the other way.
And to Danny's point, the Bank of America Global Fund Manager Survey made the point that maybe the best contrarian trade is to go long the dollar. Alicia Levine of BNY Wealth is sticking with us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. Turkish President Recep Tayyip Erdogan ordered officials to increase production of medium and long-range missiles in light of the current Israel-Iran conflict. Today marks the 5th day of fighting in the conflict, raising fears about the war spreading to neighboring countries in the Middle East. Meanwhile, Warner Brothers Discovery and CEO David Zaslav agreed on a redesigned compensation package to take effect when the company splits in two. The agreement will significantly reduce his annual salary after the split, when Zaslav will become CEO of the streaming and studios business. And American Express teased that updates are coming to its travel-focused Platinum credit cards later this year. It called it its largest investment ever, but did not provide specifics on the changes, which will apply to both U.S. consumer and business Platinum cards. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the Senate's take on the tax bill.
There's room in the spending proposals for Senate review and Senate changes. But it's not like you're going to tear the whole house down and build a new house.
Former senior Trump trade advisor Kellyanne Shah joining us next to continue the conversation on Trump's economic policy, both the prongs of course, what's going on in D.C. with the bill, as well as trade. This is Bloomberg Surveillance. A bit of a risk-off tone returns to markets as they assess exactly why President Trump is returning to Washington, D.C. and what that means for the conflict in the Middle East. Coming off some of the earlier lows, S&P futures down now just 0.5%, continuing to retrace some of the losses as the morning grinds on. Yields lower about 3 basis points, 4.42%. Crude up almost 2%, $73 for traded on the NYMEX, with a question around whether you could see some sort of disruption to oil supplies. Under surveillance this morning, the Senate's take on the tax bill.
There's room in the spending proposals for Senate review and Senate changes. But it's not like you're going to tear the whole house down and build a new house. Mike Johnson and Leader Thune are working hand in glove with the Trump administration. I hope the Senate can make progress so that we can deliver that bill to President Trump before Independence Day in just a few days.
Here's the latest. Senate Republicans proposing cutting trillions of dollars in taxes for households and businesses. In their version of President Trump's signature bill, the plan would also scale back Medicaid benefits and add to U.S. deficits. Bloomberg's Tyler Kendall joins us now. And Tyler, it feels like a bit of a head-spinning moment where we're talking about the idea of the conflict in the Middle East and questions around trade. But before we get to trade, I am curious what we've learned in terms of the clash between the Senate's version of this bill and the House's.
Yeah, hey, Lisa. Well, there is a clash between the Senate and the House, and there's actually a clash within the Senate, not to mention that this current version is also going to put the White House in a politically fraught position. And that's because it does have more aggressive changes when it comes to Medicaid. There's going to be stricter work requirements, according to this draft plan unveiled by the Senate. It also lowers the Medicaid provider tax, which essentially would amount to less federal matching funds. And Senate leaders say that this is necessary in order to offset some other priorities, including what would potentially be for certain clean energy funds, those tax credits being rolled back slower than originally imagined. That's going to upset the House. Not to mention, it also makes permanent some of those business tax incentives that we saw, such as the R&D deduction. This is something that the White House actually didn't want to see. U.S. officials tell us that President Trump liked the idea that these tax cuts were front-loaded and set to expire early because it would bring a spurt of investment when it comes to the near term. There are other things that we've been closely watching, of course. The Senate plan scales back Section 899, the so-called revenge tax. We know the House had wanted a more aggressive plan. It also lifts the debt ceiling by $5 trillion. That's an extra trillion that the House was not accounting for. But of course, the biggest sticking point still here between the House and the Senate, Lisa, is that there is a placeholder when it comes to SALT, essentially indicating to us that those negotiations are ongoing, even as those Republicans from those high tax states in the House say that that $40,000 cap that they agreed to is not up for negotiation.
Tyler Kendall, thank you so much. The tax bill is part of President Trump's three-legged policy stool. Another leg that could potentially offset some of the deficit concerns are the tariffs and the revenue that could be possibly brought into the United States. Former senior Trump trade advisor Kellyanne Shah joining us now. Kellyanne, I'm curious what we've learned, in particular from the trade discussions over as part of the G7 meetings in Canada, particularly when it comes to the UK and the US. How much of a template is that?
Yeah, good morning, and thanks so much for having me. So the big announcement regarding trade at this year's G7 was, of course, that UK deal on auto parts, on auto imports, and then aerospace. And then the executive order that the White House issued last night to accompany the deal also teased out that there would be relief on steel and aluminum for the UK at some point in the future, but the details still forthcoming. So what this shows is the UK is still very much front of the queue ahead of any other government. The next closest we got was an announcement by Prime Minister of Canada that the U.S. and Canada would be negotiating a deal within the next 30 days, which is a bit longer than we were originally expecting, but at least it's an agreement to agree.
Kellyanne, we also saw no deals from the likes of Japan, for example, and I'm sure the prime minister there would have liked to have seen something. And also the ability to reach a deal was cut short with the president leaving back to Washington, D.C. With a new hot war for President Trump to deal with and to think about, does it show the limitations of deals being led by the president? Will this ultimately slow down the timeline?
Yeah, and I thought what was interesting about the early departure, and obviously there are things flaring up in the Middle East that required his attention, was that the two deals that I thought could come together this weekend that were left on the cutting room floor, in addition to Japan, would have been India and Mexico, a deal on steel and perhaps fentanyl. He was set to meet with both Modi and Sheinbaum today. Those meetings, of course, won't happen. But I do think what it shows is some competing priorities. But look, he's got an entire team who is dedicated to these trade negotiations. USTR, Ambassador Greer, Secretary Bessent, Howard Lutnick. They're not going to be as involved as some of the defense and national security advisors will be on this Iran-Israel conflict. So they are going to be focused exclusively on these trade talks. Now, of course, that doesn't mean that one doesn't influence the other, but there are separate lanes in his administration who can handle both.
Is it your assumption then that we do get those deals that you mentioned that we were close to by July 8th?
Yeah, that is my expectation. And we really don't know what's going to happen in July. We had Secretary Bessent during a hearing last week tease that for countries negotiating in good faith, they could see an extension of that period. But the president hasn't said one way or the other. And I think negotiators are going to seek to put pressure on a number of governments where things are close in order to try to get the deal. And we've heard directly from the administration that India is close. And my expectation is that Canada and Mexico are also very much top of the queue, if for no other reason than they're two of the U.S.'s most important trading partners, and we still do have sizable tariffs on both for goods that don't currently qualify for those USMCA deals. So that's going to be a big ticket item, not just for the U.S., but also for Canada and Mexico.
Kellyanne Shaw, former senior Trump trade advisor, thank you so much for being with us and the insights on what's going on with trade. Alicia Levine of BNY Wealth still with us. Alicia, how closely are you following this? How much do you think that markets have gamed out the July 9th deadline for some of these trade discussions?
I think markets are exhausted from the trade issue and the deadlines. And I think the markets are pricing in that if they're not done, if there's no memorandum of understanding by July 9th, it's going to get postponed. I think that actually could be a risk to markets, that in the sense that the markets have sort of decided to move on to other issues than the particulars of what's happening with trade, because the administration has really highlighted that they're working towards a deal and the outcome is not going to be as bad as it was in early April. And so we're working towards lower tariffs, more clarity, something that companies can actually work with for investment. And once you have clarity, the market's fine. So I think the market has essentially put this to the side for now, and maybe that's the risk. Right. The risk is that the market's gone to sleep on this issue.
Well, it's gone to sleep on this issue, and it's gone to sleep to some degree on the budget issue. We were talking with Verrone of Strategist earlier this morning, and he was saying that really the bill that's down in Washington, D.C. is the most important thing, since a lot of people have been gaming out some sort of tailwind to the U.S. economy from this bill. I mean, how much are you watching what's going on and the sausage getting made and people basically saying this is untenable and saying, wait a second, what do we really price in here?
So I think it gets done. It's one of those do or die bill. It's going to get done. I think it's going to be very noisy. Again, when you look at the summer and you look at markets, we had a remarkable recovery, with some of the fastest in history, really, from where we hit on April 8th. So I think the summer is typically not a great time for markets. August and September are sort of like, known to be rocky. And you have the perfect Washington issue to really cause it. I think the other thing we really want to focus on what's happening with the labor market. We have retail sales today. Retail sales have obviously come in better than expected, and part of the hard data holding up and really belying some of those negative sentiment data, consumer negative sentiment data reads that we had. I was like, well, consumers might be depressed, but they're shopping depressed. So when does that change on retail sales? Because consumption is 70% of GDP. So we're watching that. There's some signals in the labor market, I think, that have not been as positive. We have to look. New claims for 2 weeks in a row, over 240, continuing claims ticking up. We need to keep an eye on that. I think it sets up. We think the market finishes higher by the end of the year, but the summer could be an interesting time.
We get jobless claims tomorrow, not on Thursday because of the holiday on Thursday. Alicia Levine of BNY Wealth, thank you so much for being here.
Great to see you guys.
Great to see you. Coming up, the son of the last Shah of Iran will be joining us to talk about the situation in the Middle East. This is Bloomberg Surveillance. Just a bit of a risk-off tone this morning, retracing some of the gains from yesterday as people look to President Trump returning to D.C. amid an escalating conflict in the Middle East. Right now, equities down about 0.5% in futures. S&P and the NASDAQ right now 2 hours away from the cash open. Here are your morning movers with Yahira Anand.
Hi, Lisa. We start with a massive mover, and that is Verve Therapeutics, up 75% on a report by the Financial Times that Eli Lilly is in advanced talks to buy the gene editing startup for up to $1.3 billion. That would double Verve's market value and give Lilly access to its promising cholesterol treatment, which could pair up nicely with its obesity drugs. Next up, we have shares of Navitas Semiconductor. They are falling 2% after Deutsche Bank hit it with a downgrade, now rating it as a hold, saying its rally has gone too far. The stock has been on a tear, up 276% since it announced it was teaming up with NVIDIA on data center technology. But analysts say the hype may be getting ahead of the numbers, with revenue still expected to be small for the time being. And last up, we have Redwire shares. They're falling 13.5% now after the aerospace tech firm launched a $200 million share sale overnight at a steep markdown. Look at this. Shares were offered at a discount of up to about 18% of its closing price yesterday. This marks another discounted sale. Just earlier, I spoke about SoftBank also unloading T-Mobile shares at a discount, albeit smaller than this one. Lisa?
Thank you so much, Yahaira. On our radar this morning, the top story, President Trump leaving the G7 summit early as the crisis between Israel and Iran presses on. Trump saying the reason for his leaving has nothing to do with a ceasefire and calling for the evacuation of Iran's capital, which led to this risk-off move that hasn't really stuck, Danny, which is sort of surprising to some people.
No, it's really remarkable to see that this is a market that wants positive news to trade on. That individual catalyst can move it lower, but for the most part, it keeps treading water. But this also brings up other issues, not just for the conflict itself, but for the fact we didn't get more trade deals because President Trump early. All we got was the UK and US deal, which already in large part had been agreed upon. There are probably so many leaders there at the G7 disappointed that they couldn't get more face time with the president. So just add that to the list of reasons that perhaps markets are kind of whistling past a graveyard.
Yeah, and some people saying because in general, geopolitics are something that fade quickly from markets. President Trump dismissing reports that the White House is eyeing negotiations with Iranian leadership. Trump posting that if Iran wants to talk, they know how to reach him, and reiterating that Iran cannot have a nuclear weapon. So really kind of raising the ante at a time when it's unclear what the U.S. role would actually be. When we're gaming out the risks, Danny, I'm struck by this question of what is the greater potential catalyst for risk-off move? Is it the closure of the Strait of Hormuz, or is it the United States going in and bombing Fordo, the underground nuclear site that ostensibly Israel would have a more difficult time reaching?
It underscores that in the fog of war, there's a lot that could go wrong and a lot that could impact markets. We've already seen a lot of the fuel ships, a lot of insurers saying it's not worth the risk. We've already seen a pullback in the Strait of Hormuz. And that would seem to indicate that perhaps oil prices can go higher, even without an outright closure at this moment. But it is a president that keeps going back and forth as to whether he really wants talks or whether he doesn't want talks. He also posted on Truth Social this morning that he hasn't reached out to Iran for peace talks and they know where to find him. So there's a lot of back and forth. It's not clear. The only certainty is uncertainty.
And it's not clear what Israel's ultimate goal is. Is it regime change, or is it just simply tempering the nuclear risk? We're going to be talking about that in just a moment. Meanwhile, the Senate proposing changes to President Trump's tax bill that would cut taxes for households and businesses, but would also slash Medicaid benefits and add to U.S. deficits. Absent from the bill is a deal on the state and local tax deduction, which includes the current $10,000 cap, and is a deal breaker for a number of members of the House who are Republicans who do come from blue states, which raises the question of just how messy this process is going to get.
Mike Lawler called it dead on arrival. One of his other colleagues from New York also said, no way, never. It's not even just that. So it's SALT staying at $10,000. It's a lower phase out of the IRA solar tax credits. It also more cuts from Medicaid. There's so many hot button issues that the Senate has altered from the House, with the House who passed over the bill saying, don't make changes to this. They still have their self-imposed deadline of July 4th. There was an idea that this weekend they could get something to agree upon. There is still so much daylight between now, the Senate and the House versions. How does this deadline come up and how are they going to meet it? A lot of questions left on that.
Meanwhile, we are getting some news from the Israeli defense minister saying that Israel is not in talks with Iran and that Israel is planning to attack significant targets in Tehran today. Right now, this is our top story. President Donald Trump arriving in Washington after leaving the G7 summit in Canada early. Trump warning residents of Iran's capital, Tehran, to evacuate the city. Trump also reiterating on Truth Social, Iran cannot have a nuclear weapon. Joining us now is Reza Pahlavi, the son of the last Shah of Iran. Reza, thank you so much for being with us. I want to start with a question. Are you in active discussions in any way to return to Iran in a leadership role if there is some sort of regime change in Iran?
Good morning to you and to my fellow compatriots following this program and all of your audience. There is a campaign for liberation that we've been committed to all these years. The moment is approaching very fast. The regime is on the verge of collapse. We see elements within the regime already talking defections. They get in touch with us. We see a leader who is now hiding in a bunker like a rat, while many high elements are taking flight from Iran. I think all of this is conducive to something that may very soon happen. And finally, my fellow compatriots will be able to overcome. And of course, there's a plan not only for this phase of our struggle, which is liberation from this regime, but what happens right next, the transition to what we hope will culminate in a democratic outcome. I have stepped in to lead this campaign at the behest of my compatriots. I have a plan of action not only to manage this phase of transition, but also to plan for Iran's future recovery and prosperity,
Wait, Reza,
which at the end has to go hand in glove with our democratic ideas.
Just a question here. Who are the compatriots who've approached you to try to helm this leadership push?
Well, I think that you have people who have vested interest in preserving this regime because their whole survival depends on this regime all this time. Whereas the millions of my compatriots who were the first victim of this regime have paid all these 4 decades a very heavy price. We have seen many campaigns that people protested. The latest one was 2 years ago, the Women Life Freedom Movement. And finally, I think today, with this clear weakening of the regime, and as I said, being on the verge of collapse, finally, all these people who have risked their lives and honorably put their lives on the line and did die for the cause will be able to remembered as heroes of this conflict, because we'll be liberated sooner than everybody thinks. And my entire commitment has been from day one to support my compatriots in the struggle for liberation. And we believe that the end is very near for the regime, and our dreams of liberty will finally be realized very soon.
Reza, on the ground, what we've seen in Iran is those in Tehran, for example, trying to evacuate. Israel saying more recently that they would look at targeting places there. You've seen fear, you've seen strikes, and you've seen death. How complicated and how difficult is it to ask a populace to rise up and rally behind you when they're the very same ones that are under threat right now?
Look, I think many of my compatriots are smart enough to understand that if until now, and in fact, many of your colleagues in the media have always asked me, how do you fight a regime that is so repressive, that is so ruthless, that executes, that threatens dissidents or activists at home? To which I said, well, obviously the playing field has to be more equalized. This is a case where for the first time in 40 years, we see this regime being declawed, literally declawed. But it is also important to have the support of the world community, because until now, many times my compatriots have been thrown under the bus when they had an opportunity to be backed, because of a policy of appeasement or containment. I think now the situation for the first time exists for the world to realize that it is no avail to expect this regime to change its attitude and behavior. Ali Khamenei is at war with the world, not the Iranian people. He's the main culprit for being here and having Iranians also have innocent victims and civilians die, to whom my heart goes out, of course. But I think right now we need to be focused on the goal and the aim. We have a tremendous opportunity to overcome this regime. I think the world would breathe a sigh of relief with this regime no longer be there.
Well,
we
Reza,
are carrying out our fight as Iranians.
Because you say the goal and the aim is a regime change. What we have heard from Israel is that their goal is to dismantle the nuclear forces from Iran. Is it your understanding that a regime change is also a goal from the Israelis, and have you been in contact with them?
I'm not asking any foreign governments to state a policy of regime change, although I think many of them do believe that ultimately that would be the best formula to get rid of so many problems at the same time, and not just the nuclear threat as a result of this regime track record of behavior in the region and beyond, fomenting terrorism, supporting their proxies like Hezbollah or Hamas in the region and so on. So the disappearance of this regime, we're eliminating too many problems that this regime has caused in one shot. The first beneficiary of regime change are the Iranian people themselves. But we believe that our immediate neighborhood, the region, whether it is the Israelis, our Arab neighbors, and beyond that, the rest of the free world will understand that the Iranian people who, unlike this regime, want to be part of the civilized world, with the same values and principles of liberty and freedom and human rights, unlike this regime, would be certainly the element of change and, if you will, the alternatives to this regime. I think this is where the world needs to be focused now, beyond the immediate campaign that is a result of the stubbornness of Khamenei, who has dragged our country into it. But let's look at the positive aspect of once we get rid of this regime, how we can envisage a future where we're back to an element of stability and regional peace, which is in everybody's interest. That's
Reza,
what we ought to be focused on.
Just to build on what Danny was asking, have you been in contact with the Israeli leadership?
We are reaching out to everyone, including the Israeli side, to understand where it is that we stand, what is the expectation of the Iranian people in terms of world support. I think it's pretty much the same thing that many struggling nations under totalitarian regime were looking at any country that understand that they have to stand with the people of a country that is trying to liberate itself. And again, whether it's the Israeli government or the American government or any other government for that matter, the question is, whose side are you going to stand with today? The Iranian people, or continue to insist negotiating with a regime that is on the verge of collapse?
There's also a question of what this new leadership looks like. Reza, are you talking about reestablishing the monarchy when that was controversial and it might not have full support from all parties, particularly the more religious elements of the Iranian society?
Well, I have never advocated for one form of a regime or another. What I did and have advocated, and in fact is part of my transition plan, is a process that is totally democratic. That means that the Iranian people have to have the ability to ponder upon whatever a constitutional assembly will propose as a constitutional formula. A future constitution, the form that the regime can take, what it will mean, and unlike 1979, when people had no clue or idea what an Islamic Republic means, and by the time they figured it out, it was too late, this time in full transparency, they'll have the option to look at what's the best model that fits them, and let the ballot box decide in majority what the Iranian people will opt for. Will it be a republic? Will it be a constitutional monarchy, or whatever it is? My objective is not to stand here as the result of that. And my responsibility right now, my only focus is to see this process through so we can ensure that ultimately we replace this dictatorship with a democratic, and let me underline, a secular democracy, where there's a clear separation of religion from state as a prerequisite.
To that point, past attempts to engineer regime shifts in the Middle East haven't often ended in liberal pro-Western governments. There are examples, many out there, Libya, Syria, Yemen, Somalia, all ending in things that look like fragmentation or current armed forces having the most power and being the ones that emerge in the chaos of a regime shift. What do you suggest that it is different this time?
I think Iranian society, not just for centuries of proving that they have, as a nation state, a concept of a nationhood, national identity, national pride and objective, a culture, a civilization, but also a polity. And a generation today, very shrewd and very clever, by knowing what it is that will be in their interest. They see the world and how it has evolved. They have seen successful campaign of liberation. They understand the key elements that sustains and preserves democratic order. And I believe today's Gen Z in Iran is more than ever equipped to understand not only the needs, but how and what it will take to implement that. Look, it's a collective project. Everybody have to roll up their sleeves and participate. The premise remains the same in the principles of liberty and human rights. But if each member of society is committed to see through it and actively engage in that process, that's where we can guarantee that it's going to be actually a result that will be positive. I have absolute faith and confidence in my compatriots and their wisdom and their know-how and their knowledge. They do need guidance, of course. They do need support, of course. They do need some level of leadership, of course. But at the end, they are the elements and instruments of change. And we are working together very closely to see that through.
Reza Pahlavi, thank you so much for your time. Really appreciate you getting on with us this morning. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Analysts over at Citi expect gold to sink back below $3,000 an ounce in the coming quarters. The team says the slump will be driven by weaker investment demand, improving global growth prospects, and future rate cuts by the Federal Reserve. Gold has soared almost 30% this year, setting a rate record back in April. Meanwhile, Meta is tapping Scale AI co-founder Alexander Wang to lead CEO Mark Zuckerberg's superintelligence group. Meta will also be investing around $14 billion in Scale AI. Known as a prolific networker and well-connected in the AI startup world, Wang's company also has large government contracts. Those ties could benefit Meta as it works to break into the defense tech sector. And Wall Street South is getting bigger by the day as financial power brokers migrate to Florida, drawn by the weather, of course, light regulation, and low taxes. Citadel CEO Ken Griffin spoke to our own Shonali Bassick for her new show, Bullish.
The optimism here is infectious. Is the American dream still alive? It's alive and kicking here in Miami because people here in Miami believe that tomorrow will be a better day. So it's really great to be here in a city that just exudes the belief that in America, anything can happen.
You can watch Bullish tonight on Bloomberg TV at 6 p.m. Eastern or stream it at 8 p.m. on Bloomberg Originals. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Europe preparing to spend.
There's been a sort of criticism that Europe hasn't carried its fair share of the burden. I've said to European allies we need to do more on spend, on capability and cooperation.
We take you to the Paris Air Show. Saab CEO Micael Johansson joins us next. This is Bloomberg. Welcome back to Bloomberg Surveillance. Let's head straight back to the Paris Air Show. Bloomberg's Guy Johnson is joining us with a special guest. Guy.
Lisa, thank you very much indeed. I'm joined now by the Saab CEO, Micael Johansson. Thank you very much indeed for joining us. You're also the president of the European Security and Defence Association. You've got a broader remit, so we're going to talk about that in just a moment. Sweden is now a member of NATO. How big a difference has that made to Saab?
Well, first of all, I think the spending is another story. I mean, Sweden has aligned itself with the forecasted spending of 3.5% as quickly as possible until 2030, I think. So the demand is incredible, but I think it means a lot from a capability perspective as well. I mean, we've been sovereign, of course, so we still have to have a strong defense, but we also have to think about us where we are geographically and how we support the Finnish border towards Russia, how we handle the Arctic perspective in a different way in partnership with other countries that have an interest there. And the capability targets is adding a lot, of course, to the Swedish Defence Forces to think about rather than just taking the national perspective. And then we have all the infrastructure. We've been a sort of a south-north country thinking about quickly getting to the northern part of Sweden from a defence perspective. Now we have to think sort of west to east, which is lacking infrastructure. So lots of things to the whole society.
In terms of what that means for your company, you are having to ramp up very quickly.
Yeah.
Is that possible? Is it possible to get from kind of a peacetime mentality workload to a war-footing workload? Kind of how far through that process are you? What needs to happen? Where are the bottlenecks? What are the challenges?
We're quite far through that. I would say we have in certain areas quadrupled output of what we did before the war broke out in Ukraine to now having hundreds of thousands of ammunitions coming out of our factories, as an example. I do think we need to do more, and what we lack now is sort of understanding the aggregated demand, I would say, and what sort of target level should we have to have a sustainable, high-level capability in terms of capacity, and that needs sort of NATO somehow telling us where to go and Europe telling us where to go. So I think we have a few steps still to take, but we have invested heavily in capacity now. And also, of course, new technology, embracing new technology to bring forward new capabilities.
Europe needs in so many ways to figure out how to work together better. And fighter jets, you make the Gripen fighter jet, is an example of that. This morning I was speaking to Eric Trappier, who runs Dassault. He makes the Rafale fighter, used to make the Mirage. We've got him working together with Airbus, maybe for not much longer, we don't know yet. We've got another group which is led by BAE with Leonardo and the Japanese in it. There needs to be a level of coordination that doesn't seem to be there at the moment. What's missing? Why can't we make this work? What do we need to do to get it to work? And what can Saab do to be part of that process as well?
Well, I think this is about national sovereignty and having what we call as industry as OEM capability. If you look at the Western world today, it's only 3 countries that would have that today. I would say it's us, Sweden. We build fighter jets and systems of systems. We have France capable of doing that through Dassault and so forth, and we have US. Now to sort of divide that somehow, but still keep the OEM capabilities in a few countries is the key to this, I think. You need to find your partnerships that doesn't let you get into the level of being a supplier rather than a partner.
Right.
You need to find both. MBDA is a good model of that. They've done that. They've done sort of a missile capability thing where some countries have enough OEM capability and sovereign capability to feel safe from a security supply perspective, still being a pan-European company. That we need to accomplish also in Europe if we would like to go that way. Now, I wouldn't say it's bad to have a couple of suppliers of fighter aircraft in Europe, so I don't know how much we need to consolidate. But in other areas, we definitely have to consolidate more.
Michael, great to see you. Thanks indeed for stopping by to see us. I think we're about to see a Rafale fighter jet taking off. It's about to get very noisy around here. So on that note...
I wish it was a Gripen.
I'm sure you do, definitely wish it was a Gripen. I'm sure it would be just as noisy, though.
It was. Okay. Thank you.
I'll throw it back to you guys in New York from the Paris Air Show.
Thank you so much. Bloomberg's Guy Johnson. Wonderful work, as always. And I was expecting to hear some jets taking off just then.
I know. It kind of doesn't feel right. You need the Paris Air Show and something... I'm glad it didn't, because that was a great interview, but it feels very apt for the Paris Air Show to be drowned out by noise.
Just taking a step back, and we are heading into an hour where we are going to get retail sales, and there is this question of how much it would take for U.S. economic data to take the front focus away from what's going on in the Middle East. It seems like there are a lot of questions, and that conversation that we just had with the son of the late Shah really, again, spotlighting a potential regime shift in Iran.
It's very true. And it is also something I spoke with Bob McNally of Rapidan about, that if you did get a regime shift and you did get a more friendly pro-Western government, it opens up this huge energy market. Just to put it on the energy side and market sides, obviously it has bigger consequences than just that. But a populace that is pro-friendly to the West, it would really, really change things. But history tells us regime shifts are messy, and it is never that straightforward.
As you asked, and it was a good point, the idea of how this has worked in the past has been inconsistent at best. Coming up next hour, as we turn our focus to the economic data, Nadia Lovell of UBS, Gil Luria of D.A. Davidson on the rally we've seen in tech shares, Pooja Sriram of Barclays, and Herr of JP Morgan Investment Management. This is Bloomberg Surveillance. Good morning.
This is a year to adapt, and forecasts have been less relevant.
Let's not be too defensive. There's a real opportunity cost to being under risk.
You don't want to be short, but you do want to get a bit more defensive.
The pain trade overall still could be higher.
It's going to be potentially quite a volatile next year and a half.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. We're going to do something a little different. We're going to try to focus on the economic data for a hot second while keeping an eye, of course, on the Middle East. We are less than 30 minutes away from retail sales in America for the month of May as the Federal Reserve begins its two-day meeting in Washington, D.C. We're going to get to the Middle East in just a second, but first, Danny Berger, how much we're looking at the consumer at a time where that really ultimately remains the question. Can they keep spending amid all this uncertainty?
And will the market pay attention? I love the question you asked. What would it take for the economic data to break through? And let's be honest, even some of the stuff in the Middle East isn't breaking through to the markets. But there's a lot on the mind of consumers. The sentiment surveys have been volatile at best. You have something of a wealth effect with what stocks and equities have done this year. Can they hold up in this? Will you start to see the beginning impact of tariffs, of higher inflation, add whatever uncertainty is happening right now in the global economy to that too? Or are we just going to continue on and it's going to be more uncertainty and we won't know what to make of the data?
And to your point, I think it's a really solid one, this idea of how does the market take potentially weaker prints and do anything with it? Does it expedite the expected timeline for the Federal Reserve to cut rates, given the fact that you potentially are dealing with stagflationary shock? The price of oil very much in focus, rising again, yet again today. As we do look to a possible disruption in the Middle East, people talking about some sort of ongoing conflict between Iran and Israel that could lead to regime change or some other type of pretty significant disruption. How much does this make it more difficult for a Fed to figure out how to even message this?
And what would be the reaction of markets, even as they message it? Just look at the bond market today. Even with oil higher, you see yields coming in. You see a bid to bonds. Ian Lingan of BMO writing this morning that suggests that we aren't even moving in the direction of what the fiscal deficit does. That maybe it's already all priced in. By the way, another thing, just to consider what the market's doing. But maybe this market is back to caring about what the real economy does and the threat of reflation. So, hey, maybe retail sales does matter today.
Maybe people are just exhausted or uncomfortably numb right now in markets. We're tracing some of the losses from earlier in the session. Futures down less than 0.4% on the S&P 500, as Danny was just talking about. A bid into bonds, which is different than what you've seen over the past few sessions on the heels of some of the fighting. And you are seeing a bit of dollar weakness, although really it's basically range bound versus the euro, 115.63. Coming up, Nadia, Lovell of UBS with stocks lower on continued fighting in the Middle East. Pooja Sriram of Barclays with that breaking retail sales data that we were just talking about. And Herr of JP Morgan as the Fed kicks off its two-day meeting. We begin with this top story. President Donald Trump arriving in Washington, leaving the G7 summit early as the Middle East crisis escalates. Annmarie joins us from the G7 meeting in Canada. Annmarie, do we have any additional information, either with respect to what President Trump will be doing, what his inclination is, whether it's to make peace or not, and just what kind of response there is in D.C.?
Well, the president is going to be spending a lot of his day in the Situation Room with his national security team. He kept it incredibly vague, but he did say that he is not in the mood right now for negotiating, and Iran should have struck a deal when they had a chance. Now, he's going back to Washington, D.C. at a time when there's growing speculation about the potential for the United States to get involved in this conflict, to join Israel, not just in a defensive posture, but in an offensive posture. The president, speaking to reporters yesterday, had this to say: I didn't say I was looking for a ceasefire. I'm looking for better than a ceasefire, an end, a real end, not a ceasefire, an end. And then he also took as well to Truth Social, talking about all that was going on and also lambasting Emmanuel Macron, who he said got it wrong, telling reporters that potentially the president was looking for a deal. Trump did say, though, he may send his special envoy Steve Witkoff or the vice president, J.D. Vance, to meet with the Iranians. But he said it depends on what happens today. And that is why all eyes are not just on Tehran and Jerusalem today, but on Washington, D.C.
Annmarie, thank you so much. Safe travels back to New York from Canada. Right now, we're focused on what the market's response has been. Nadia Lovell of UBS writes, the Israel-Iran conflict remains fluid, but we expect limited impact on markets if it remains contained. Nadia joins us now. And Nadia, that seems to be sort of the common thought here. As long as this remains contained, we can ignore it and keep on whistling our way. How do you even understand at what point you have to be paying more attention?
You know, I think if you just look at the historical playbook, I think that's why many market participants think that this will be limited if it remains contained. Because when you look at historically, if you look at the last dozen or so of geopolitical conflicts, a week later, the market is flat. A year later, it's up high single digits. But what could turn this is if the U.S. gets involved and that leads to a disruption in oil flows by, some sort of blockage of the Strait of Hormuz. Yes, Iran has threatened that in numerous occasions, but never has there been a full blockage. So that could lead to a spike in oil price if that happens. And so right now, the market seems to be looking through it. We think that the market will continue to look through it as long as the U.S. remains out of the conflict.
If you didn't want to look through it and you wanted to protect yourself against what the impact might be if there is escalation, how would you do it?
I think you've seen it already playing out in the marketplace, this flight to quality. The flight to quality now is really that safe haven assets, it's gold, right? We think that gold could get to 3,800 if you see a further escalation in this conflict. And also people are trading oil, right? Oil could spike up into the $100 range. That is not our base view. We continue to think that oil prices is more reasonable at $68. But if you lead to some sort of blockage that disrupts the flow of oil, then you could see that spike in oil prices. Right now, it feels like the market is pricing in, the sort of $75 to $80 range, which suggests that they're expecting some sort of disruption to Iranian oil and not a wider spread disruption to the oil coming out of the Gulf.
You didn't say bonds as something that would protect you in this moment. You have seen the initial reaction was to sell bonds, maybe an inflationary concern. This morning, we're buying them. How do you understand between the different drivers, between geopolitics, a bill, between trade discussions, the economy, what really is breaking through and driving the market narrative?
I think it's all of that, and the market is trying to muddle through this narrative. I mean, when do we shift back the attention to the big, beautiful bill and the increased deficits and what that will mean for longer-term interest rates? I think that's coming. Again, I think we have to get through this week and see what happens within the Middle East for the market to sort of shift its attention back towards that. So right now, we think that, you know, in terms of bonds, not to say that bonds shouldn't be part of your portfolio, it is, but right now it doesn't feel like it's that part of that flight to quality trade that we have seen in the past.
I feel like we do this every week. I feel like every single week. Let's get through this week, and then next week will be much more clear, and we'll have a greater sense, and we'll be able to focus on something simple. Hasn't worked out that way.
I don't think that's what I'm not saying that. It's sort of checking off one problem and moving on to the next, right?
Okay. So then let's talk about the next problem, and that's going to be the actual U.S. economy, where there's been some interesting data, right? We've seen the ongoing continuing claims rise to the highest level going back to 2021. We're expecting a decline in headline retail sales month over month for the month of May. At what point does this become a headwind to some of the bullish calls for equities that are predicated on high valuations and continuing earnings growth?
Yeah, you know, looking for $830 for retail sales. Now, again, this data could be somewhat tricky in the sense that there was a pull forward, as we know, particularly around autos, home furnishing, in the prior data ahead of the tariffs. So it isn't clear what the underlying trend should be. So some of the weakness could be argued away if you see weakness in retail sales having to do with that. I think what's most important is, yes, those initial jobless claims that keeps creeping up higher. And even the payroll numbers, right? If you really dissect that, like 139 sounds fine, but if you dissected sort of the downward revisions that we see in the pattern of 440 to 50K downward revisions, if you put that in and expect the same sort of downward revision, you might be under 100K in terms of payrolls. And so I think that's going to be important to watch, not only for, you know, consumer spending, but also the Fed reaction function as it tries to balance that dual mandate, the potential for high inflation coming through from tariffs and the potential for a weaker economy in terms of a slowdown in job creation.
It seems to be this moment that we're getting a push and pull from so many different factors. And you often get that sort of volatility, that oscillation, when you are on the verge of a regime shift. Does it feel like we are on the precipice of something really changing, of understanding maybe cracks in the economy or something different just with all these disruptions that are happening?
I think, you know, this is something that the market is struggling, and we're all struggling. I wouldn't say a regime shift. Its reality is when you go back to the fundamentals of the equity market, the underlying fundamentals still remain strong in the U.S. When you go back to sort of the tech and the AI story, the electrification story, all of that sits within the U.S. But when you think about what's already priced into this market, you have a market that's trading at 22 times forward PE. And when you look at the last few years, that's sort of like the upward bound in terms of hitting that resistance level for further multiple expansion. So it comes back again to the growth story near term over the next 6 months or so. We do expect a slowdown in growth. That is going to be a drag on earnings growth. We're looking for about 4% this year in earnings growth. And so right now we think that the market is fairly valued at, you know, 6,000 on the S&P 500. But if you look into 2026 in sort of the middle of the year, we think you can get to 6,400 because we hope to have clarity. And I know hope is not, you know, a strategy, but it does suggest like by the time we get to, you know, September into December, that we will have further clarity on trade, further clarity on monetary policy, and the exact impact on the economy from tariffs.
In the meantime, we're all buffering and just trying to get to the weekend. Nadia, Lovell of UBS, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. Senate Republicans have drafted a new version of President Trump's signature economic package. The bill raises the debt ceiling by $5 trillion and makes permanent 3 business tax breaks that were set to expire after 2029. The plan comes at the expense of curbing health coverage for some low-income Americans and makes no mention of a deal on the state and local tax deduction known as SALT. Meanwhile, Meta has tapped Scale AI co-founder Alexander Wang to lead CEO Mark Zuckerberg's superintelligence group. At the same time, Meta will be investing around $14 billion in Scale AI. Wang is known as a prolific networker and well-connected in the AI startup world. On top of that, his company has large government contracts, which could help Meta as it works to break into the defense tech sector. And the Oklahoma City Thunder are one win away from an NBA championship after beating the Indiana Pacers in Game 5. Thunder star Shai Gilgeous-Alexander and Jalen Williams combined for 71 points in the win, while Pacers star Tyrese Halliburton scored only 4 points. Game 6 is set for Thursday evening in Indianapolis. That's your Bloomberg Brief. Lisa?
Thank you so much, Yaira. Coming up next, the morning calls, plus Gil Luria of D.A. Davidson on the latest tailwinds for chips. This has been what's supporting the entire U.S. equity market, leading it higher. That's coming up next. This is Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. We're tracing some of the losses from earlier this morning. Futures down now less than 0.4% as people take a look at what the opportunities are and what the potential risks are for some sort of escalation in the Middle East. A bit of dollar weakness, but nothing really significant to discuss. 115.70 on euro dollar cross. And you can see that bid continuing to gain steam into treasuries. 10-year yields 4.4%, down 4 basis points as crude up 2.2%. That point, Danny, you were making earlier, that if you were concerned about this being an inflationary type of shock with oil, kind of a gut check for that, given the risk off feel actually giving a bid to the Treasury space.
It's really hard to understand what exactly is moving bonds because there's a lot that could. It could be inflation with oil in the Middle East. It could be the big, beautiful bill. It could be trade discussions. It could be the economy with what we get with retail sales. So you get this back and forth, but the net sum of it has been treasuries that have been in a really tight range as of late, especially since April when we saw a lot of volatility. So what is it going to take for them to break through? Lots of catalysts that could do just that.
And people saying that they've been in a range for about 2 years. So if you want to extend that range to a longer place, time now for the morning calls. First up, RBC maintaining its sector perform rating on Lennar, noting that better than expected gross margins overshadows a slight miss on orders, and those shares are up almost 2% with a focus on the home builders later this morning. Some home builder data coming out at 10 a.m. Eastern today. Next up, Spotify raised to a street high price target of $900 by Pivotal Research, seeing opportunity in AI advertising, and those shares down just by about 1/3%. And finally, Bank of America raising its price target on Roku to $100, citing the platform's exclusive Amazon partnership. Those shares up about 2.5%. Let's stick with tech because this really has been the main driver, frankly, of a lot of the gains we've been seeing in markets. Nvidia closing near a record high yesterday as it remains Wall Street's darling. Gil Luria of D.A. Davidson writing the success of OpenAI, AI coding tools, and the proliferation of AI agents are driving a continued build out of AI data centers. This has benefited mostly Nvidia up to now, but investors are increasingly expecting Broadcom and AMD to participate. Joining us now, I'm so pleased to say, is Gil Luria of D.A. Davidson. Gil, I want to talk about just how much investors are picking up on this. Is this what we're seeing right now in markets, or some of these names that it's not just the Magnificent Seven, it's the FANG Plus, those 10 names that include Broadcom and AMD, that seem to be driving us forward at a time when people still very much believe in this AI trend?
Well, that's right. The AI trade peaked last year. It went away a little bit, and now it's back, and it's back for good reason. We are seeing the AI tools starting to work, starting to contribute, and we're getting a sense that the investment will continue. Maybe not at the exponential rates we've seen so far, but it will continue. And NVIDIA is still the main provider of these chips, but it is broadening, as we point out. Broadcom helps Amazon and Google make its own chips. Increasingly, those big customers, Microsoft, Amazon, Google, Meta, don't want to just rely on NVIDIA. So they're expanding their scope and including AMD. And then there's a whole range of upstarts that will come public soon. Cerebras, Grok. There's a small company called Blaze, BZAI, that makes chips that do AI at the edge. This trend is big and it's broadening. And until we have more of a sense of where it benefits in software, investors continue to gravitate to semis because they know AI has to use semis.
Gil, I'm struck by the idea of what happened during the dot-com bubble, and some of the big leaders during that time are not the leaders that we see today in terms of the internet space. How much disruption do you see over the next year of some of the giants, some of the Magnificent Seven that might be rendered, I want to say obsolete, but a lot less relevant as a result of some of the really cutting-edge technology?
Well, as it happens, it is actually the largest companies that will benefit next. So Microsoft has already done phenomenally well and will continue to do so. Their Azure business is growing 35%. That's a $70 billion business growing 35% as they provide access to these GPUs to their customers. Amazon Web Services growing fast, Google Cloud growing fast. So it is actually the largest companies that are benefiting, but there will also be smaller software companies. Nebius is another provider, but your Snowflake, your Datadog, infrastructure software companies will also start benefiting. And at some point down the road, we'll see the applications that will become hits beyond coding and chat, which is what we're using AI for now. The applications will get a lot more broad, and then application software companies will benefit. That may not be the biggest companies, but right now, it is actually Microsoft, Amazon, and Google that are benefiting the most from providing access to AI services.
A lot of that growth, just in terms of their AI offering and what they have under the hood, has been inorganic, Gil. And we had the most recent one with Scale AI, a huge investment, $14.3 billion from Meta in that deal. Do they have to spend those levels of money? Is this type of investment necessary in order for them not to get left behind?
It tells you how high the stakes are. So Mark Zuckerberg believes that having one of the dominant AI models is the most important thing right now. That's why he literally spent $14 billion to hire Alexander Wang, which is mind-boggling. It's mind-boggling. They're going out there with offers of 8 to 9 figures for AI researchers. And it's even more mind-boggling that some of those AI researchers at OpenAI and Anthropic are turning that offer down because they have so much equity in those franchises. Having said that, Mr. Zuckerberg is correct. Having the best AI model is very important. There will at some point only be 1 or 2 successful models that we use for broad purposes. There'll be a lot of small AI models that we use for specific purposes, but he sees it as a goal to have the best open source AI broad model. And since his previous effort with Llama 4 was a failure, he felt like he needs to rebuild that team from scratch so he can become competitive again with OpenAI, with Anthropic, with Google's lab. And that's why he's remaking that team at all cost right now.
Gil, is that somewhat, though, of an argument against the smaller players doing well in this environment, that you have these big behemoths that have the capital to hoover up smaller players and, by the way, have been rewarded by shareholders for doing so? Does that mean that we are trending towards an environment where the big are getting bigger because they are buying the smaller competition?
For now, yes. For now, you need this enormous infrastructure in order to be successful. Really, only these companies can be successful. Add OpenAI and Anthropic, but mostly because they're backed by Microsoft, Amazon, and Google. But that doesn't mean there won't be entrepreneurship here. There will be a lot of application companies that come out of here, because one of the things that's magical about AI is that one individual can now build an entire software stack. Using AI coding tools, you can build the website and everything behind it yourself at a fraction of the cost that it cost even 3 years ago, and at a small fraction of what it would have cost 10 or 20 years ago. So this will lead to a huge wave of entrepreneurial activity and startups around AI applications. But the core infrastructure, only the largest players can afford to play in that space.
Luria of D.A. Davidson, thank you so much for that insight. And I did punch into ChatGPT just now. What should I pay attention to with retail sales data? And it's been having a really hard time bringing anything up. And luckily, we have a human, Michael McKee, who covers all of this and who can actually tell us what we should be looking for. Michael McKee joining us ahead of that print that we get in just a couple minutes' time. What are you looking for, Mike?
It really should say on ChatGPT, listen to Michael McKee.
Actually, it might. It still hasn't come up, but carry on.
Well, the interesting thing last month was how widespread the declines were. They weren't huge, but they fell off in a lot of categories. This time we're looking for two separate areas to decline: energy prices, which is not a bad thing for the economy, and auto sales. And that should push down the overall retail sales number, according to the Bloomberg survey, by a fair amount, 0.6%. But the control group, which takes out gasoline and auto sales and also home improvement sales, is expected to rise, and it had fallen last month. So we'll look for some spending, some modest spending by consumers during the month of May. The real question is how much of a rebound do we get? And then we'll be asking, is it going to continue as people sit and wonder and worry about what's going to happen going forward?
Michael McKee, thank you so much. We'll be catching up with you in just a minute as we look to understand how much people are spending on hobbies like sporting goods and potentially musical instruments. I mean, these are the types of things that give you a sense of how much discretionary income people feel like they have right now.
Yeah, and how much of it is, oh, they're depressed. I think Alicia, Levine said this earlier. They're depressed, but they're spending maybe to help alleviate some of that depression. But there are things you've noted, like initial jobless claims ticking up, just general volatility that can dampen sentiment when it comes to different conflict and when it comes to trade and potential inflation. How much does that really break through? You haven't seen it on the headline numbers yet. Could this retail sales number be the first little peek we get into that?
Yeah, right now, definitely markets taking it all in stride, seeing a retracement from some of the earlier sell-off that we saw in futures ahead of that retail sales data. Coming up, we will get that for you in just less than 5 minutes' time. We're also going to be speaking with Pooja Sriram of Barclays about that data and how this will affect the Fed's meeting, if at all, as they parse through not only what's going on in the economy, but also what's going on in the Middle East and with global trade. This is Bloomberg Surveillance. 25 seconds until we get that key retail sales data for the month of May in the United States. Right now, you are seeing a bit of a risk-off feel across equity futures. S&P futures down 0.4%, a bid into the bond space. And interestingly, a strong bid into the 2-year in particular as we await this data. Down 4 basis points, 3.93%. Similar kind of move on the 10-year and the 30-year. Let's head over to Michael McKee, Bloomberg economics and policy correspondent, for that data. Mike.
Well, we have a significantly worse headline number than expected, down 0.9%. The revisions haven't come through yet, but the last month initial feed was 0.1% gain. Ex-autos and gas were down 0.1%, so it is autos and gas that are pushing this lower. And then the control group comes in better than expected, up 0.4%. The expectation was for 0.3, and it had fallen 0.2 in the month of April. Import prices also in, they're flat on the month. Ex-petroleum, they're up 0.2%. Now, you can't read too much into that, because while some exporters from overseas might have lowered their prices to the U.S. To make up for tariffs, the tariffs are not applied until the products get here. So these are landing prices, and we won't see a huge amount of tariff effect in those. But the story at the moment, a 0.9 decline in headline retail sales, which is likely autos and gas. I'll check the categories, Lisa, and you can check the markets.
Yeah, the initial reaction, and Mike, thank you so much for that, was definitely a bid into the 2-year. You're seeing that fade just a touch. You're seeing initially a risk-off mood deepen in equity markets. What you are seeing is this feeling that this would give some further incentive to the Fed, or at least East wouldn't necessarily restrict their ability to cut rates in the near future. Two-year yields, just taking a look at that, off some of the earlier knee-jerk reactions that you first saw, were down just about 3 basis points, 3.93%. A little bit of further dollar weakening versus the euro, but really not a massive move. Mike, you've had a couple of seconds to take a look. Is anything standing out to you in terms of what exactly among the indicators outside of oil and gas led to the decline in headline, but also the strength that we saw in the control group?
In general, there was a rebound in most categories that fall into the control group, but we do have some declines. The clothing and accessories group was up 0.8%, sporting goods up 1.3%, general merchandise stores up 0.1%, although department stores were down 0.4. Non-store retailers, of course, this is basically where you're going to pick up your Amazons and your Walmarts online, up 0.9%. The declines were pretty much as expected. Motor vehicle and parts dealers down 3.5%, building material dealers down 2.7%, and gasoline stations down 2%. So people did see some price declines in gasoline, and they did see, or they did decide they didn't want to buy more cars after loading up earlier in the year. And so the pattern is kind of what we expected. The one discretionary category we always talk about is food services and drinking places, down 0.9. So if you're looking for any sign of people's concern about what might happen to the economy, maybe they're pulling back a little bit there. That seems to be about our only real negative that wasn't expected at this point.
Michael McKee, thank you so much. Maybe they also were just having a dry May. Danny, what's your take on this? I mean, it seems like if you're looking for clarity, this ain't it.
It's the opposite of clarity. It's more uncertainty. It is a control group that did better. It is a headline that did worse. And by the way, you did see April revised down to a negative 0.1%. It was pretty much flat last time we saw it. So no drama at the moment, but that doesn't change anything. The fact that you didn't see any deterioration, unfortunately, doesn't change anything, because you could make the argument, yes, we're really resilient, things are holding up, or you can make the argument that everything was pulled forward, people are still shopping, and you're not seeing impacts of tariffs and uncertainty yet.
Well, Pooja Sriram of Barclays joins us now with her own argument. Pooja, how do you interpret this? Thank you so much for being here, given the fact that there's something for everyone, which is kind of the theme that we've seen in a lot of the economic data recently.
That's true. Well, so far, I sort of agree with what she said, in the sense that right now it just looks like everything seems to be good. So far, so good is how, I would put it. But it's hard to say how things are going to pan out sort of going forward. A quick take on the retail sales from my end is that we had expected a slightly weaker control group. So the fact that it actually did better than we'd expected is, again, maybe, like she said, maybe a resilient consumer. Income fundamentals, wealth fundamentals for consumers have been looking good. It's something we've said on and off. But I do expect at some point a pullback and a moderation in consumer spending to materialize. Did it happen in this sprint? It didn't.
Maybe there's a correlation, though, between the decline that we've seen in oil and gas prices and the increase that we saw, the strength that we saw in the control group, because there's a theory that if you're not paying as much when you go to fill up the tank in your car, you have more to spend on other things. How much is that thesis threatened if oil prices start to spike at a time of conflict in the Middle East?
No, that's a valid point. The one thing that I would add is that, the spending on gasoline as a share of consumer spending isn't as high as what most would think. It's about 2 to 3% for the consumption basket. So you would need a pretty persistent and a pretty big rise in oil prices for consumers to actually start feeling threatened and for them to actually start pulling back. It's what we call like the discretionary income channel, because you have to spend on oil. We think demand is relatively inelastic for oil. And so when you have to spend more on oil, you're forced to sort of pull back elsewhere. So that is a risk, but we think it's developing. I wouldn't say that's a baseline right now.
When it comes to a consumer that you expect eventually to weaken, what is the trigger for it? Because we already see some underlying weakness in the labor market, a little bit in there, things like the unemployment, some of the weekly initial jobless claims ticking higher. Companies are not hiring right now. There seems to be a freeze. What needs to change for that actually to trickle down into some weakness for the consumer?
Well, I think two things. We need to see this consistent discipline, gradual slowing in the labor market for the consumer to start feeling a little worried. The other thing which we've been saying that should happen eventually is as the prices start increasing because of tariffs, there could be some pressure on the consumer purchasing power. When both of these things materialize together, is a world in which we think the consumer would feel cautious about spending, and that's when we should hopefully start seeing the personal saving rate tick up because you're trying to save up.
Just be clear, does it actually need to happen? Because you have seen the sentiment measures sour quite a bit to start this year. They've been bouncing around since then, and there's a whole host of reasons why maybe you shouldn't pay attention to them. But is the expectation for economic weakness or geopolitical strife, do any of those sentiment type issues weigh on the consumer, or do they keep spending through it until the actual prices, the actual data changes?
Well, it's hard to say, but I would think there has to be some amount of precaution that has to set in. The other thing that we've been saying is the price level is already so high across a whole host of commodities, goods, and this is an aftermath of the pandemic, that now any additional price increase, we think the consumer is likely to be sensitive to that.
Just to, if you're just joining us right now, just to reset, we did get retail sales that came in on the headline level weaker than expected, down 0.9% versus the expected 0.6%. That sounds negative. That sounds like a weakening. Oh no! And then you take a look at the control group that came in stronger than expected, up 0.4% from the 0.3% that people had been expecting. The revisions to the prior month, as Danny was talking about, also were revised to be less bad than they were initially. And it raises this question of what the response in markets is. The response is interesting, actually. What you're seeing is less of a bid to the 2-year yield and more of a bid to the 30-year yield, which signifies that maybe people see this, and I'm really taking liberties here, as an excuse for the Fed not to cut rates as quickly because of that strength in the control group that could lead to longer-term weakness. Pooja, how much are you looking at that type of scenario that people say the longer the Fed is on hold, the more longer term we see potential for a decline in inflation expectations and more weakness?
Well, I think in the near term, it makes sense for them to be on hold, just because there's an obvious tension between what we think is going to happen to inflation and the fact that we're not seeing a very material slowing in the labor market. So I think in the near term, it makes sense that they're on hold. I don't quite buy the argument that it would necessarily lead to more weakness going forward. I think it is going to give them a window to come in and cut rates.
Okay, so this is the argument some people have made, and this is sort of the question that we've been bandying around all morning. Why wouldn't the Fed come out and aggressively be hawkish to try to tamp down inflation expectations? And then later this year, if things do weaken, they can say, okay, just kidding. We actually do want to cut rates. I mean, why is that not the playbook for the Federal Reserve?
Well, we think they might actually come out and look pretty hawkish in the June meeting, right? Our own forecast is for the June SEP is to look relatively hawkish. We think the median dot would show only one cut in 2025. And that makes sense. I think the signal that they would want to send out at this point in time is we are watching inflation expectations. We are cognizant that inflation could go higher. The labor market side of the mandate for the time being looks okay. And so, I think the message from them is we're in no rush to cut rates. And I think it's the flip side, right? Should things actually materially start to weaken, they could come in and cut rates.
It's interesting because Bloomberg Economics has the same outlook, Anna Wong and her team there, but they said Chair Powell isn't as hawkish as the rest of the committee. So if you get one dot on the dot plot of cuts, expect Chair Powell to come up and kind of downplay and say, oh, we have a range of outcomes. It doesn't matter, not least of which because he'll probably get political pressure coming from the White House should that be the outcome. Do you expect Chair Powell to also lean more hawkish in his communique to the press after the decision?
I think that's going to be a tough one. I think he's going to stick to the messages that he's always, been saying. We're in no rush to cut rates. We're going to wait and watch. We need to see how the data evolve. So all of that. I don't know if he's going to particularly be dovish, but I think he's going to stick to the message. The other thing I feel is, most people would also look at the SEPs quite closely, at least analysts like ourselves, and we're literally counting the number of dots everywhere. So we get a sense of, I guess, how the committee is leaning as well.
Counting dots. That's what we have to look forward to for tomorrow. Pooja, Sriram of Barclays, thank you so much for being with us. Great to see you. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Recapping that latest data, U.S. retail sales fell by the most since the start of the year. May data suggesting new tariffs deterred customers from spending, especially on cars. The value of retail purchases not adjusted for inflation decreased 0.9% after a downwardly revised 0.1% decline in April. Meanwhile, Israel's defense minister says the country is not in talks with Iran and that it will attack significant targets in Tehran today. The conflict between the two countries is in its 5th day, while Chinese President Xi Jinping said he's ready to play a role in restoring peace in the Middle East. And when it comes to politics, Citadel founder Ken Griffin is making education his top priority.
I decided it was important to support politicians, both Republicans and Democrats, who put education as a very important part of their platform. And over the years, I've continued to support candidates on both sides of the aisle who really do lead with an education-first policy. I find in general I tend to agree with more of the policies from the Republican Party, but it's important to recognize people in both parties that really do lead the charge fighting for the interests of children.
Ken Griffin sat down with our own Shonali Bassick for the premiere episode of her new show, Bullish. You can watch tonight at 6 p.m. Eastern on Bloomberg TV or stream it at 8 p.m. on Bloomberg Originals. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Thanks again for this morning. Really appreciate it. Up next, we'll be setting you up for the day ahead. Plus, Herr of JP Morgan will be joining us as we parse through the reaction of bond markets and look ahead to what we can expect tomorrow from the Fed's rate decision. This is Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. Right now, we can see a bit of a retracement from the initial reaction to retail sales. The knee-jerk response in two-year yields has been completely removed. Now we're down just slightly versus the 5 basis points initially. You're seeing stocks around that 0.4% decline, same as what we saw earlier. Less than an hour away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with solar stocks plunging even more in the pre-market after Senate Republicans unveiled a bill that would end tax credits on solar and wind by 2028. That's years earlier than for other energy sources like nuclear. So you are seeing Sunrun down 37%, while SolarEdge and Enphase Tech Energy are also down. But I will say the bill could still change. Next up, we have Digital Turbine. This is an ad tech company. Shares are up 6.8% after it reported its first quarter of growth since 2023. The company also blowing past earnings estimates, showing signs of a potential turnaround for the company. And last up, we end with Lennar. Shares are up 1.5% as investors look past its miss on new home orders and focus on other areas like better than expected margins, not just in the past quarter, but also up ahead, which is interesting since it's had to lean on incentives to entice people to buy their homes. Lisa?
Thank you so much, Yahira. Right now, counting you down to the opening bell. Here is the trading diary for the week ahead. Today, the Federal Reserve kicking off its two-day meeting, which does end with a rate decision tomorrow. The G7 summit is underway in Canada, but without President Trump. He had an early departure. Wednesday, jobless claims plus a Fed rate decision and Chair Powell news conference. Thursday, U.S. markets are closed for the federal Juneteenth holiday, and we'll get another rate decision from the Bank of England. The Fed's two-day meeting kicking off today. Joining us now is Herr of JP Morgan, who sits on the desk along with Bob and Priya and Kelsey, and you're letting them have the store alone. Is it going to be rough?
I have complete confidence in those three.
Well, so right now we're looking.
Although, truth be told, I'd rather that they were here on Bloomberg and I were back minding the store.
Okay,
I confess
well,
that.
Kelsey was here yesterday, and we'll definitely have
Priya
and Bob coming
tomorrow.
up. So there we go. But I do wonder, when you take a look at all of the different storylines that we've been focusing on, which one kind of is the most important to focus on for the bond market at a time when potentially you could see an inflationary pressure from oil, but you do see signs that consumers aren't exactly stretched, but they are just showing some discretion to prices?
So I was sort of chuckling when I was listening to Pooja and you talking. You said, maybe I'm taking a liberty on the bond moves, a basis point here, a basis point there. And I think that's the answer to your question, Lisa, is that the narrative for us is yields are actually attractive. The U.S. economy is slowing. You saw it in the jobs data, cutting back, an average of 50,000 fewer jobs a month being created. You see a little bit of a decline in retail sales. You see consumer confidence coming up a little bit. There's a lot of cross currents here on the economic data, some strength, some weakness. Looks like overall GDP growth is slowing back towards 1.5% or something like that. There's so much obsession about every single data point, and yet yields are attractive, bonds are doing what they're supposed to be doing, and there's a role for them in portfolios.
So then let's talk about positioning, because ultimately, if it's not necessarily about the fundamentals at any given day that we then take liberties, which is what I just did, and
I
interpret that.
for the record.
No, it's true, but you're not wrong. Then let's talk about that. We've been talking about how crowded the short dollar trade is. Is there a similar type of crowded trade against treasuries that you see somehow reversing at a time where there is attractive yield?
No, I mean, you're right about crowded dollar, but I would also say dollar is essentially overvalued for several years when you think about real exchange rates, you think about purchasing power parity. So it's not surprising that people move in and then things crack. In terms of the treasuries, I think the curve looks okay to us here. We think there might be some continued steepening. I think there's more attractive opportunities outside of treasuries. There's a lot of comments about the tightness of spreads. I'm not going to sit up here and say that high yield spreads are very cheap versus history, but yields are actually attractive. So whether you're looking at corporates, you see attractive yields. You look at asset-backed securities, you look at some single-family rental and collateralized mortgage-backed securities. There's a whole host of value in the bond market, and I think if you get the overarching theme that the U.S. economy is slowing, we don't see it hurtling toward a recession yet. Fed's probably on hold tomorrow. Look at retail sales, which you and Pooja just assessed very deeply. Yeah, headlines, it's a noisy number. It's 50, it could be plus or minus. I think the margin of error for it is 50 basis points one way or the other. So I'm a little bit more in a let's not make too much ado about every single data point. Let's look at the narrative. Let's look at the totality of it and try to focus on managing portfolios and deliver alpha for our clients.
Well, to be fair, Kay, I think if you asked everyone trading bonds right now, they'd probably say the same thing. There wasn't that much of a reaction to the retail sales data. Whereas in April, mostly based off of the different policy coming out of the White House, there was so much volatility. And volatility that really led a lot of people to say bonds as the haven in your portfolio is the state asset class. That time is over. Foreigners are going to flee. There's going to be a buyer strike. Considering we've been in a tight range and that volatility has ebbed, are there any scars left from that period, or can we move on?
Okay, well-articulated view on the bear case of bonds. And I think what's really important to remember on bonds is they are a great indicator of what the growth of the U.S. economy looks like. So you didn't see, you were talking yesterday, you didn't see a big reaction yesterday, and bonds weren't the safe haven yesterday. Well, as difficult as geopolitical turmoil in the Middle East is, it's not really going to have a major effect on U.S. economic growth. So I think that's the real focus is. So to answer your question, no, I don't see significant scars from that. I think if you look into U.S. ETFs, this month alone, you're seeing greater flows into U.S. ETFs for fixed income than you are for equities. So I think some of the healing has done, and people are remembering that bonds do have a place for portfolio, especially if the risk to the economy is a recession.
Well, one of those other risks that likes to bubble up is what's happening to the deficit. The big, beautiful bill making its way through Washington, D.C., the core of it, despite changes, is intact, is one that does expand the deficit. At some point, Secretary Scott Bessent is probably going to have to come out and talk about larger auction sizes and changes to how they're thinking about issuing that debt. Does that break through at all, or is it all already priced in?
So I think a couple of things. Number one, I think it's primarily priced in. There's an extraordinary amount of noise about the one big beautiful bill. I think the second thing to remember is that Treasury Secretary Bessent is a markets guy. He and the president are very focused on what the bond market is doing. And I think if you look at our fiscal situation, while I wouldn't say that it's pristine, we are certainly far better than an economy like Japan, which has much worse deficits. So I think that the Treasury is going to be very thoughtful about issuance. You see last week, you've got this comment about declining interest in Treasuries. Last week's auctions were actually very strong. And this trend of reduction in interest in Treasuries has been going on for the last 15 years. So I think this is a lot of good news about not a lot of fact.
In fairness, you were talking about how you just have to follow the narrative. It's been a little hard to follow the narrative. Let's be honest. I mean, we've all been trying to do it every single day.
The narrative changes every 5 minutes.
Pretty much.
Which is why I try to keep even-keeled about it and not overreact to things that are going on.
Well, we love your perspective, and let's do it again soon. Thank you so much for being here. Herr of JP Morgan, talking about how ultimately there's yield. And that's ultimately what we're seeing when it comes to certainly today. And last week, when we had the auctions, there was a bid into bonds, and it seems like some of the fear had been much ado about nothing.
Exactly, and also speaks to Kay's point about corporate credit, why there is such a bid there, that the yields are still attractive. And to be fair, the only place that you're starting to see any sort of signs of a pickup in defaults is the junkiest of junk in corporate credit. Elsewhere, it is really strong, and again, that just kind of feeds into risk assets being able to float along, because it's that old thing of credit's the canary in the coal mine. There ain't no canary singing here.
Well, there is a question about how much this is all in yield versus spread, because when you actually look at the valuations, they are looking pretty rich when it comes to just how much you're getting compensated. But if you are a yield-based investor and you like that, it does seem like that is the reason why people are going into that. We will continue this conversation. Coming up tomorrow, we have a discussion with Julian Emanuel of Evercore ISI. Don't miss that. George Saravelos of Deutsche Bank, who has been calling for the diminishing of the U.S. dollar as a haven currency. Gargi Chowdhury of BlackRock, and Claudia Saab of New Century Advisors ahead of that Federal Reserve meeting and rate decision that does begin today. This was Bloomberg Surveillance. Good morning.